right, so let's get started. So what I'd like to do tonight is to, let's go over the market updates. Okay, so if you didn't already be tracking the markets, you should go up on to Yahoo Finance and look at where the Dow Jones Industrial Average closed today. Is it up or down by what percent and by how many points? What's driving the market up and down, and you could be Googling, all that information. Oil prices, where are oil prices trading?
Professor, I don't think we can hear you on Zoom.
Okay. Okay, test. Can you hear me now, Brandon?
Yeah, all loud and clear.
Okay, great. Thank you for doing that. All right. Test. Let's test your mics too.
Sir.
Okay, just test the mics, please. Okay, can you test your mics for me, please?
Hello.
Keep going, because I'm adjusting the sound.
Got it. Hi.
Hello.
Professor, your class is always right during the NBA Finals games.
Oh, is
Not
it?
called for
Oh,
but-
I think last time I was, my class was during the World Series or something like that. Can you try it again? Test the volume, please. Can you test the volume, please?
I mean, can we put a bet on it, on like which team wins? Maybe we can drop a homework assignment or something?
Oh, there you go. You can do every other homework problem. How's that?
I love that idea.
Okay, go ahead.
All right, Suns in 5. That's my bet.
All right, let's, I'll bet you 3 donuts.
You're on.
Okay, can you hear everybody? Okay. So what I need you to do is I need you to go up onto Yahoo Finance. Tell me where the Dow Jones Industrial Average closed today. Is it up or down by how much in percentage terms and in points? Where is oil trading right now? Is it up or down by how much? And give me 2 or 3 reasons why. Same thing for gold per ounce, same thing for the 10-year Treasury yield, and the same thing for the US dollar to euro, US dollar to pound. Okay, so where did the Dow Jones Industrial Average close today?
44.44.
Okay, I can't hear anything.
44.44.
That is incorrect.
Is it 34,757?
What is it?
It's called 34,730.
Okay, that sounds right. Is it up or down?
It's down.
It's down.
Yeah.
By how much? In percentage
Percentage.
terms and in points?
Negative 24 or 0.24%.
Okay, and then how many points?
86.
It's down. It was down 86 points.
That's what it says right here.
Okay.
82.
Okay.
I see 83.
Okay. Is that a lot?
No.
No. So remember, anything between positive and negative 100 points is nothing, just white noise. If it's over 250 points, both positive or negative, there's some kind of news event. If it's up or down, negative 500 points, a major news event has occurred. And if it's up or down by 1,000 points, there's something major that's happened. Okay.
Wait, say that one more time? So it's pretty much
If it's up or down, negative or positive 100,
Mhm.
it's just white noise. Okay. If it's up or down 250 points, there's news. If it's up or down, positive or negative 500 points, there's major news. And if it's up or down by 1,000 points, there's something big that happened. Okay, so nothing really happened today. Was there any news in the marketplace? Did interest rates go up? Did the Biden plan get rejected? Was there any geopolitical events in the Middle East? Did Russia invade some country? Did, what's going on in the world?
Well, they were talking about, people were estimating that we would be able to go back to normal in the sense of, output and money-wise, but with this new Delta variant, it looks like we're gonna have to take a step back, in production, and that wasn't what they were anticipating, so I was reading, I believe on Monday, that they were trying to adjust because people were saying like, oh, we're gonna be back to normal, quote unquote, within the next, few weeks, if not months, and now it's looking like we have to take another step back with the new variant.
That's right, that's right. And it's unfortunate, is that not only domestic, or is that on a global basis?
It's global.
It's global. So, if you are anticipating higher infection rates, higher hospitalizations, and higher rates of death, what is the probability of future lockdowns?
Higher.
Higher. And if there are higher probabilities of future lockdowns, does that indicate higher or lower economic activity?
Lower.
Lower economic activity. Does that indicate higher or lower inflation and inflation expectations?
Higher inflation rates.
Higher.
Hold on, lower economic activity? So if the economy is growing slower, is there gonna be more or less supply in the marketplace and more or less demand? Less
Less
demand,
supply, more demand.
more supply, less demand. So what's gonna happen to prices or inflation? They will probably go, say it?
Down.
They will probably go down, okay? And if they go down, if prices go down, what happens to interest rates? If inflation expectations go down, and inflation expectations is the number one factor that drives interest rates up and down, if the market thinks that there's gonna be less economic activity and lower inflation expectations in the future, then interest rates are gonna go down, okay? And then that should be confirmed in the 10-year treasury. Okay, so the 10-year treasury has now been declining consecutively over the last 2 weeks due to the assessment by the market, because the Biden plan has been scaled back from a $2 trillion infrastructure bill to a $1 trillion infrastructure bill. And because of the Delta variant, now we're seeing higher infection rates with higher probabilities of lockdown, that the market is now starting to forecast lower economic growth and lower inflation and inflation expectations. And that is driving interest rates down. And the stock market was down a little bit today, which probably reflected some of that view, but it wasn't a major event or major news at this point. What else happened today? I believe that was major. That could have impacted the markets. You gotta be online, you gotta be like scrambling for information, you gotta be going to, stock charts, big charts, Yahoo Finance, you gotta be looking at Bloomberg, you gotta be, do you guys get notices on your phone for stuff? Interest rates, do you sign up for apps to be able to, provide you with, real financial information? What else was a big deal today or yesterday? Who controls monetary policy and short-term interest rates in the United States?
But wasn't it the treasury?
Huh?
The treasury or?
Yes, the Federal Reserve, exactly. And was there a meeting today?
Yeah.
Yeah, and who did he meet with?
I don't remember, but I did see the headlines that say that he's still kind of, it's saying it's the same as expected, where there's a point where you don't need to worry yet, but there could be. And
Yeah.
they're watching the indicators to see what's
Yeah, he met with Janet Yellen, who was the prior Federal Reserve Chair. And she's now the Treasury Secretary. And they talk a lot, because they have to coordinate both fiscal and monetary policy. So that was a big deal. And then any statements that came out from her or him will have an impact on the marketplace. Not only the stock market, but also the bond market. So it's huge. It's really information. The market is constantly researching. The market is constantly listening to, you know, what the Fed is saying, what the Treasury Secretary is saying, what the President is saying, what the economic indicators are indicating. Everybody's watching the market because they want to figure out where things are going. And if they think the market's going to go down, they're going to sell. If they think the markets are going to go up, they're going to buy. And they're constantly buying and selling. So that's what the traders do. Okay, was there any other news that would have affected the markets? Did you guys
Mortgage
see?
applications jumped the most since January.
That's a really good economic indicator. What would cause mortgage applications to go up?
Low interest rates?
Lower interest rates, exactly. And what would be another factor that would drive mortgage applications up?
A lot of people are moving in regards to.
People are moving, and then what do you need to buy a home?
Money.
You need
Money.
And
Wages
our,
are higher.
right, and then, you know, people have been locked down for 14 months. Were they out spending at malls during that time period? No, they were probably doing what?
Saving.
Saving, buying down debt. So a lot of them have down payments. And with low interest rates, mortgage applications have jumped. And what's happening to home prices?
They're dropping.
Well, what's happening to home prices? If people have more money and mortgage applications are going up, what does that tell you about demand for homes?
It's increasing.
Increasing. So what would be happening to home prices?
They're gonna rise.
And what has home prices been doing? Going up. At the highest rate since probably 2006, 2007. Okay, so we're basically in another housing boom. Could be a housing bubble, we don't really know yet. We'll see what happens. Okay, really good. Where is the price of oil per barrel? Trading.
72.47?
72?
Yeah.
And where was it over the last month?
It was at 73.13.
Yeah, but where was it? Has it been trending up and then now trending down?
It was going up and then today it's down.
Yeah, and then what was the high?
Of today?
No.
For that month.
No, yeah, in,
76,
yeah, $76, $77 a barrel. And where is it now?
72, 48.
72. And what does that tell you about global supply for oil or global demand for oil? If prices are going down.
Presently, it's not as high as it once was.
Yeah, if prices are going down, what does that tell you? Do we have more or less supply or more or
We
less
have more
demand?
supply.
We got more supply and
Less demand.
less demand. Got it. Good. And if the COVID infection rates and the Delta virus leads to more shutdowns and the economic activity starts to slow, what's going to happen to global demand? It's going to go down. And what about global supply?
It's going to increase.
It's going to go up. And where do you think prices are going to go?
Down.
Probably go down. Okay, excellent. Where is the price of gold per ounce?
It's $1,816.30 per ounce.
Great. And what's it been trending? Is there a trend to it?
Yeah, it's increasing.
It's been going up.
It's going up? Okay. And is gold prices, is gold a commodity?
Yes.
Yes. Does gold prices track and reflect inflation?
Yes.
Yes. So if gold prices are going up, what does that tell you about inflation expectations and inflation?
Inflation is supposed to increase.
It's going up.
Going up, exactly. And the producer price index just came out, I think it was yesterday, 8%. Okay, is that high?
Yeah.
Yes. Okay. And the consumer price index was between 5 and 6%. Is that high?
Yes.
Yes. Okay. Inflation's been running about 1.7, maybe 2% for the last decade. Okay. Now we're seeing really high producer price inflation, consumer inflation, home inflation, material cost inflation, and it all gets, flowed through. And if people see inflation increasing, what happens to the value of the dollar?
It decreases.
It depreciates, exactly. And if people think that the purchasing power of their dollar is gonna fall, would they buy or sell gold?
They would buy it.
They buy gold, exactly, as a hedge against inflation. What about geopolitical risk? Would people buy gold as a store of wealth and a precautionary balance? Yeah,
Isn't gold-
absolutely.
Yeah,
Isn't gold just pretty much a guarantee?
So do you think that people could be buying gold too, driving up gold prices because they see political instability and economic instability due to the Delta variant viruses?
absolutely.
Absolutely. Got it. Okay, really good. And then where is the 10-year treasury yielding?
Negative 1.7 BPS.
Okay, where is it, where is the yield to maturity or the interest rate on the 10-year treasury? And then how much did it drop? I think that's what you were getting at, right?
Oh, sorry, it says to yield 1.398%.
Got it, 1.39, and where was it? Over the last week, or where's it been trending?
Down.
It's been trending down, right? So where was it?
In the past month, it got up to $1.50.
Well, it's 1.5%.
1.5%. Yeah.
Got it, okay. So 1.15, and let's say it dropped to 1.4%, how many basis points did it drop?
0.1?
No. It was 1.5%, how many basis points is in 1.5%?
15?
How many basis points is in 1 percentage point?
If the increment's a 0.1, wouldn't it just be 10?
No, it's 100. You need to write this down. So in 1 percentage point is 100 basis points. So when the 10-year treasury yield peaked at 1.5%, how many basis points was that?
1,500?
No, how many basis points was 1.5%?
150.
150. And if the yield to maturity or the interest rate on the 10-year treasury dropped to 1.4%, how many basis points is that?
140.
140. So what's 150 minus 140?
10.
10. So how many basis points did the 10-year treasury drop?
10.
10 basis points. Excellent. Okay, you guys are now fixed income traders. The number one factor that drives interest rates up and down is inflation expectations. Okay. Another factor that drives prices of bonds up and down is interest rates. Okay. So if there's higher demand for bonds, bond prices are going to go up and interest rates are going to go down. Okay. If people are selling bonds, bond prices go down and interest rates go up. If people think that inflation is going to be higher in the future, there's going to be higher inflation expectations, that's going to drive interest rates up and bond prices down. So what did the 10-year treasury yield do?
Went down.
It dropped by how many basis points?
10.
And if the yield to maturity of the interest rate on the 10-year treasury dropped, if interest rates went down, then bond prices went up. Got it. Excellent. You want to write this metric down too. This is what I figured out. If you add 150 basis points or 1.5 percentage points onto the 10-year treasury, you will get the 30-year fixed mortgage interest rate. So if the 10-year treasury dropped 10 basis points to 1.4%, and if I add 1.5% to the 1.4%, what does that give me?
2.9.
2.9. So where do you think mortgage interest rates will be, either within the next couple days or the next 2 weeks? Where do you think they'll be?
2.9%.
Got it. So you can add 150 basis points and 1.5% onto the 10-year treasury yield to get the 30-year fixed mortgage interest rate. So if you see that mortgage interest rates are falling, and you think inflation expectations are falling, and economic activity is gonna slow, and you think interest rates are gonna fall on the 10-year treasury, do you think that the mortgage interest rates will also fall?
Yes.
Yeah. And would you buy your home, would you lock in your mortgage interest rate now, or would you wait maybe a week or two if you could, if you thought interest rates were gonna fall?
If they're gonna fall and wait.
Oh,
Oh, wait,
yeah, you'd probably wait. Okay. And then once the interest rates drop, then you go in and you lock your loan, because interest rates could go back up. And then you lock your loan, you lock your interest rate. Okay? All right.
So it takes a couple weeks for the.
It could be a couple days to a couple weeks.
Okay.
Okay, but that's what I found. So if the 10-year treasury is starting to trend down, then mortgage interest rates are gonna trend down, which means that the cost of mortgage finance to buy a home is trending down. And what will that do to mortgage originations and demand for mortgages?
It'll increase it because the interest rates
It'll
are
go
lower,
up.
so you don't.
You got it, and Daniel, didn't they go up?
yeah, though if the prices are cheaper, then the demand will go up.
Yeah, I'm just saying that as interest rates went down, didn't that increase mortgage originations? Didn't you
I
just,
just another question, sorry.
didn't you just say that mortgage originations went up significantly?
Yes?
Yeah, that's my point, is that that interest rates have been falling and people are starting to take out more mortgages because the cost of mortgage finance for single-family homes has gone down significantly. So that's driven up mortgage finance, the origination flows, which then predicts that there's gonna be higher demand for homes, which is gonna push up home prices. So if interest rates continue to fall, what do you think is gonna happen to mortgage originations? They're gonna continue to go up. And if there's more finance, cheaper finance available, is there gonna be higher or lower demand for homes? Higher demand.
Higher.
And if there's higher demand for homes, what's gonna happen to home prices?
They're gonna rise.
They're gonna go up.
lower.
They're gonna go,
Up.
if there's more cheap finance, people are gonna take out more mortgages. And if mortgages are cheaper, they'll be able to bid up home prices.
Yeah, more, higher demand, higher price.
Exactly.
Will that also lead to more houses being built?
Yes, if there's enough demand, enough land. The problem with the supply side of the equation from homes was that material costs went up significantly over the last 4 to 5 months, to the point where it started to slow the rate of new home construction. But now that material prices have come down, and if the economy is slowing, material prices will probably continue to come down, and demand for homes will continue to go up, and the developers will come in and start to supply more homes. Okay, all right, excellent. And then what about the dollar to the pound and dollar to the euro? How many dollars does it take for me to buy a pound?
Is that the GBP?
Yeah, that's well, there's the euro and then there's the pound.
What is it, the US dollar is valued at 1 and the pound is, 0.72.
Yeah, but how much does it cost me to buy a pound?
$1.38.
How much?
1.38.
Yeah, so 1.38 for the pound?
Yeah.
Is that correct?
Yeah.
Okay, and then how much did it cost me to buy a pound, let's say on Monday or last week? Cost me $1.38 right now. How much did it cost me at the beginning of the week or last week?
Yeah.
$1.39?
Yeah, it's just about,
Okay, so $1.39, and now it costs me $1.38. Is it more expensive or cheaper? Cheaper. And if it's cheaper, it means that the US dollar did what against the pound? Appreciate or depreciate?
appreciated against,
Did what?
Appreciated?
Say it again?
Appreciated?
If it's cheaper
Yeah.
for me to buy a pound today,
Oh, cheaper to buy a pound, yeah, it appreciated in that case.
that means the dollar appreciated and the pound
Depreciated.
got it. Okay? So if it's cheaper for me to buy a pound, that means the dollar appreciated. And the pound depreciated against the dollar. Got it. Do you think that the movement in the currency exchange rate between the dollar and the pound would be correlated with the dollar to the euro?
Yes,
Because they're what? Like right across the street from each other?
pretty much.
And do you think that the British economy is highly correlated to the European economy? Therefore, its currency exchange rates would also be
Similar.
correlated? So let's test it. How much does it cost me, dollar to the euro, how much does it cost me to buy a euro? $1.18?
Yeah.
And then how much did it cost me?
$1.19.
$1.19. So, and now it cost me $1.18, it cost me $1.19. Did the dollar appreciate or depreciate against the euro? Appreciate.
Appreciate.
And then did the euro appreciate or depreciate against the dollar? Got it,
Appreciate.
got it. Okay, so the dollar's appreciating, all right? And there's many factors that would cause currencies to appreciate and depreciate. But, you know, global economies, open economies for trade, open capital markets allow for currencies, for capital to flow across the world freely. And the ability to move money in and out of countries based on their currencies and based on exchange rates are going to determine the fluctuations in currency exchange rates. Okay? Excellent. Any questions on that?
Would you say that that is more a product of the US dollar appreciating or the pound depreciating?
Well, it's a good point. The question for me is not necessarily economic growth, because the US is doing pretty well and Europe's doing pretty well. I think the major factor that's driving currency exchange rates, if they really start to trend, is the severity of the Delta virus and the probability of economic shutdowns. So maybe the traders are thinking that Europe is in worse shape than we are, because we have higher inoculation and vaccination rates than certain parts of Europe. And maybe because we have more, you know, people that have been vaccinated, that the severity of the infection rates may not lead to more severe economic shutdowns. I'm just kind of thinking, if I was a trader, you know, it's either economic growth, inflation, and COVID, you know, are the factors. And when you read about currency exchange rates and the movement in the dollar compared to the euro, they're going to be talking about those things. They're going to talk about those things in the articles.
So would you say the number one factor in changing like currency markets is mostly just world news, or?
Yeah.
Okay.
And then the hypothesis is called the efficient market hypothesis. Okay? The efficient market hypothesis basically states that information that comes to the marketplace, if it's significant, will impact stock values, oil, gold, bonds, currencies. So the market is constantly looking for information to reassess their expectations of the future. And the price of stocks, gold, oil, gold, bonds, and currencies take into consideration the movements in the prices and the values, take into consideration all factors that come to the marketplace randomly at any point in time. Okay? So economics, economic activity, inflation, and now pandemics, you know, and infection rates, will have an impact on all of those asset prices, politics, geopolitics, and any other factors that would be driving the markets. Interest rates, those are, so if I was building a model, those are all the macro factors that I would probably have in my model if I was trying to forecast all of those asset classes. Okay, any questions from people online? No? Okay, so Yahoo Finance is really a great place because it has basically the dashboard here that you can go through. You're gonna have to find the currency exchange rate somewhere, but this is a great place to start. So, you know, when you come in before class, I would go up there, start looking at the dashboard and start getting ready to, you know, start this dialogue, okay?
Does it close, does it change after close? Because when I checked
Yeah, it
here
does.
at close,
It
the
does.
prices are all.
Yeah, because what happens is some of these indexes start to go to the futures markets, okay, and the futures markets are traded after the close. So you have the indexes that will be calculated, you know, second by second during the trading day, and then after the close of the New York Stock Exchange, then the futures markets open.
So the number I gave earlier was the close, and now it's showing futures, that's
Yeah,
why it was.
Now, sure, that's right, no, that's why it's different, okay? All right, excellent. And then what I did was I went up to Bloomberg, okay, and you can go up to the Bloomberg site or you can use my username and password, and I started looking at the major news. And actually what I do, you know, probably every day or every other day, I get bombarded by articles, you know, into my, my email box. And I go through them, I click on them, I open them up, and I basically then take these articles and I push them out through my LinkedIn channel to my network. So I'm pushing out information that I think, and you can send me an invite to my LinkedIn page so you can sign up for my posts and you'll get in my feed, okay? But I'm telling the marketplace around me what's important, and this is like one of the most important things right now. Okay? The infection rates, they shut down the state capitol. The infection rates in Marin are starting to move up significantly. San Francisco too. The South is getting just hammered, okay? So it's coming here, okay? And it's gonna get worse. And what we're seeing is basically the Delta virus start to show up in infection rates, hospitalizations, and deaths increasing because of social gatherings during the 4th of July. So it took 2 weeks basically to incubate, and now we're starting to see it, okay? And unfortunately, the majority of the infection rates are people around 30 and kids, okay? Where before, it really targeted people that were older and obese with diabetes and, you know, compromised systems. Now that it looks like the Delta virus is starting to target children and people in their 20s and 30s, okay? So vaccination rates are extremely important right now.
Okay, quick question for like staying up on the market, would you say Bloomberg Live is best, or The Economist, or both?
Oh, they're all good.
Okay.
What I would do is, you know, pull them up, log in, and then I would kind of check them all. And you'll see some repeating stories, but at least it'll get you in the habit of doing the research, okay? Because you never know when people are gonna ask you stuff. You're a business major, maybe you were a finance major, business people, the senior level executives follow all this stuff. Because they gotta know. If something like this happens, the first thing they're gonna wanna know, well, we were gonna bring our people back in September. We've already started bringing our people back, you know, in July. We might have to hold off on that and then allow people to continue to work, you know, remote. So it has an impact on policy, particularly at the corporate level, but also at the government level too. So this is all real life stuff, okay? And it's just unfortunate that we have to live through this, but it's the reality. So this was a big one for me. The other one that was big in the news for me, I was hoping that it was gonna slow up a second. had these already set up. Okay. Key Democrats hold back on budget deal until details offered. The Biden administration, not only did he have a $2 trillion infrastructure bill that got whittled down to $1 trillion that had an effect on the markets, particularly interest rates, is he's got a I think it's a $3.5 trillion budget that he's got to negotiate with his party to be able to bring through Congress to have it be approved so that he can execute on it. Now he's going into the budget battle. So 3.5 trillion plus 2 trillion, that's basically $5.5 trillion potential government injection of demand in the economy if the infrastructure bill would have went through at 2 trillion instead of less than 1 trillion, and we'll see what happens to his budget. And you gotta remember that in this budget, you have entitlements, okay? Social Security, Medicare, transfer payments, social welfare, okay? Entitlements is the third rail. Because you're not gonna mess with the baby boomers, right? That are retiring and people over 65, the AARP, the Association of Retired People, is like one of the most powerful lobbying groups in Washington. You touch their entitlements and their Social Security and their Medicare, you're out, okay? So entitlements probably aren't gonna get touched in the budget. And they're not gonna touch military spending either, okay? And that's almost $800 to $1 trillion right there of the budget. Is a third of it is military expenditures, okay? That's not gonna get touched either. So if there's gonna be any cutbacks, or trimming in the budget, it's probably gonna be targeted to discretionary spending, okay? Subsidies, education, health, maybe not healthcare, maybe housing appropriations, maybe food stamps, to people who live in poverty. Social programs could get cut. So you will start to hear the debate in the budget and what will be negotiated between the Republican Party that has filibuster capabilities in the Senate to basically block passage of legislation, even though the Senate and the House are slight majority to the Democratic Party. They still need some Republicans, particularly in the Senate. But the Senate can invoke the filibuster. So the politics in the United States affects the economics through policy, particularly in the budget and other types of appropriation bills. Government expenditures is a factor in the calculation for gross domestic product, for economic activity. Consumption by individuals, investment by businesses, government expenditures, and net exports are the factors that drive economic activity measured by gross domestic product. Okay? So the budget bill, will have a major impact on economic activity, and if people think that the budget is going to get whittled down, infrastructure bill is going to get whittled down, the social programs are going to get whittled down, is there going to be more or less government expenditure? Less. And if there's less government expenditures, there's going to be more or less economic activity. Less economic activity. And if there's less economic activity and demand for goods and services, what's going to happen to inflation? It's probably going to go down. And if inflation and inflation expectations are expected to go down in the future, what's going to happen to 10-year Treasury yields? They're going to go down. And what's going to happen to 10-year Treasury bond prices? They're going to go up. Exactly. Okay? So it all kind of flows together. There's like a logical sequence amongst the economics. Okay? What I would do is be writing those sequences as I kind of go through them. So you're practicing what the causation, right? Not correlation, but the steps in the causation. Okay? All right. So this was a big one too. So there's a lot of news around that. Sorry about this. I only got a few of these. here's the other one. US stocks edge higher, treasury yields decline. So if treasury yields are declining, what does that tell you about future inflation expectations? They're going down. Got it. And if future inflation expectations are going down and interest rates are going down, then what's happening to long-term bond prices? They're going up. Got it. Okay. All right. So that's a pretty good one too. BlackRock, which is one of the biggest fund managers in the United States, 4th and Howard Street in San Francisco, they invented the exchange traded fund. They're starting to raise salaries significantly because they're getting pressure, because they're seeing labor shortages. So they need to increase the salaries to retain their employees, and they need to increase the salaries to compensate their workers for the deterioration in the purchasing power due to inflation. He's probably one of the most powerful people, on Wall Street. Powell sees tapering a ways off. So there's quantitative easing. The Fed prints money, buys bonds. If the Fed buys bonds, then what happens to bond prices? They go up and interest rates go
down.
So the Federal Reserve will print money, buy bonds, drive up bond prices to drive down interest rates to keep the economy growing and stimulate the economy. Got it. Powell sees tapering a ways off. So there's quantitative tightening, which is also called tapering, okay, where the Federal Reserve won't print as much money, won't buy as many bonds. And if the Federal Reserve doesn't print as much money and doesn't buy as many bonds, okay, what would happen to bond prices? They would go down and interest rates would go up. So if the chairman of the Federal Reserve is saying the tapering, the quantitative tightening, is not going to happen for quite some time in the future, what do you think interest rates are going to do?
Continue to go down.
They're probably going to continue to go down. And then where do you think they're going to go a ways off?
Back up.
They're probably going to go back up as the Fed starts to come out, starts to back off. So the Fed is concerned about what right now?
Inflation?
They're concerned about inflation, but what are they more concerned about if they're keeping interest rates low?
Economic stimulus?
Yeah, they're concerned about economic stimulus, but they're more concerned about economic growth. So if the Federal Reserve continues its quantitative easing to basically print a lot of money to buy bonds to drive bond prices up and keep interest rates low, then the Fed is more concerned about what than inflation? Economic growth. Okay. And could the Fed be concerned, particularly now, with the rise in infection rates and higher probability of shutdowns, that we could see significant slowdown in the economy because of it? Yeah. So why is the Federal Reserve printing, buying bonds, and keeping rates extremely low? What are they scared of?
Shutdown.
Yeah, but what are they trying to avert?
A bubble?
What are they trying to avert? If the economy goes down, what does it go
Depression.
into?
Depression.
No, not a oppression, a recession. Got it. Now, has the U.S. economy ever fallen into a double-dip recession, historically?
What do you mean?
Well, where you have back-to-back recessions.
No,
You
it's
fall
normally-
into a recession, then you start to recover, then you fall into another recession.
Normally it's a period of time.
Yeah,
It's
but
like
is there
double.
any history
No.
of the United States falling into multiple recessions within very short periods of time, double
What is
dips.
short?
Within maybe 12 to 24 months,
No.
Yes,
yes.
in the 1980s.
Yeah, 82, 84, I think there was also one in like 73, 75. We had a severe recession from 91 to 93. Okay, we had a severe recession in 2001 through 3. We had the mother of all post-World War II recessions in 2008, 9, and 10. And we had basically a depression last year. If you look at the economic indicators, we've never seen anything like it, okay? And you gotta go back to like the 1920s and the 1930s prior to World War II to find anything similar to that, okay? So the Federal Reserve is worried about what?
Recession.
A double-dip recession, more than
Inflation.
inflation. Got it, okay? Excellent, you guys are great. All right. You guys are picking it up very quickly. Okay. So then, what I want to do, I want to kind of switch gears a little bit. Have you guys been up to the shared drive yet? Have you guys been up to
Yes.
the shared? Okay. And then you go into the shared drive. I don't think I showed you guys this. Here's the template right here. What I set up for you. What you can do is what I do is I go into here and I basically make a bunch of subfolders. And then what I do is I go into here, into this subfolder, and I basically just click on this, I copy that, and go back into my folder, right click on the subfolder, and paste the label. Okay? So that basically all of your subfolders look exactly like this. And they're sorted in order. Okay? And I'll give you a cover page, and when you're ready, I don't know, has anybody made an attempt at the memos? Okay, awesome. So, and you're online? Are you on Zoom? Yeah. Yeah, go into Zoom, and then what I can do is you can pull yours up, and then what I can do is do a demonstration, and use yours as a learning tool. Okay. So that's where you're going to store them. This is the pretest. Anybody attempt the pretest?
I started it.
Yeah. So
Started
pull
it.
it up, take a look at it, so that everybody who may be, not up to speed, we can take a look at it, I can give you some comments. That looks great, keep going. Oh, you need to add some figures here, or diagrams or equations. You forgot to put the correlation coefficient equation in there, so I give you some feedback, okay? And then what you'll do is you'll say, Professor Souza, I got my memo, I got my pre-test, oh, and I've been, taking notes, on your midterm demonstration and uploading the, the notes in there. I've been putting my homeworks, in there. I got the pictures in there. I decided I'd write it out. I did a movie review worksheet. I'll show you where those are. I watched The Inside Job. I filled it out, took a picture, uploaded it. I'll send you that one. We're doing a presentation tonight with our team. I put my team members' names on the cover of the presentation, and what I did was I uploaded the PowerPoint presentation, and for the other presentations that the other students were doing, I typed up some notes or wrote up some notes, took pictures of it, or I just uploaded the doc, or the pictures or the PDF, whatever, so you can see the notes for the other chapters that I took. So I was following along. And then we're not going to do the class project. And then you have your class notes. Oh, Professor Souza, I uploaded my resume too. So I think I'm ready to meet with you for about 15, 30 minutes to go through everything so you can give me some feedback. And that's how I do it. Okay. All right. Is that all clear? Okay, cool.
Has this already been shared with us, or?
Yeah, you should have access to it. Has anybody gone up and, because I sent out, I think, 2 weeks before the class, I put you guys on to be able to share.
So the midterm is gonna be the notes?
Yeah.
So we should update on the notes file and also on the midterm?
These notes, Should be mostly the market updates,
Oh, okay.
yeah, with any other notes that you're taking. And then the notes around the exam, you can just upload into the exam folder. Did that answer your question?
Kind of.
Okay, so you know how we,
I'll like mix it on my notebook, so. I feel like
just do the best you can. And then you can just walk me through them. You know, I'm just,
And
the notes are really, I'm just checking to make sure that you're engaged and you're following along. And then as I start to go through the midterm, you can, those are the notes you want to take around the exam.
so just two more questions. The homework from the book, should we need to post it handwriting or?
Yeah, or you can just abbreviate or do bullets or something if you want to, but don't just plagiarize and copy and paste.
Okay.
Okay,
And
I want you to learn the materials.
And everything that we are not totally done, we should upload it like anyway? Like the pre-test, I'm like a half.
Um,
Should I upload the half that I did it already, or just when I'm done?
You can tell me when you're halfway done, you can show me, or just show me when I meet with you, and then when you're done, you can upload it.
Okay.
So usually what I do is, you know, this class is what, only 5 weeks?
Yeah, 3 more weeks.
Yeah, so, you know, next week you should start uploading stuff and showing me. And then what I'll do is at the end of the semester, I'll either meet with you on a one-on-one, or you can upload all of your material and say, Professor Souza, everything's uploaded, you know, I'm ready for the grade.
Professor, for the pre-test, I believe you said you wanted handwritten. If we do it handwritten, are we able to just take photos of it and
Yeah.
upload it to the drive?
Yeah, totally.
Okay.
Yeah. Yep. Or you can scan it and pull it up as a PDF. I actually like the pictures because it goes into a gallery format, and I can actually check it a lot quicker. But it doesn't matter, what's ever best for you guys. Okay? So basically I've gone completely digital in this class because of COVID. I think it's just I think it's better. Okay. Did you guys have any other questions? No, is everybody clear on expectations? Okay, cool.
I have a quick side question for you.
Yeah.
How fast do you think COVID moved like education into the future? Like with regards to like everything being online now for you, like
It was pretty rapid. I mean, it was just crash, right? It was a meteor that just came in and crashed. There was online offerings before, but we didn't have Zoom. I've been talking to the university for years saying, you know, I would love to have some kind of application. Skype doesn't do it, but I would love to have some kind of gallery, like a Hollywood Squares type thing, where basically we have interoperability and interactivity, just like we have right now with Zoom. But there was no technology back then, right? The technology was invented and then it was fully adopted, you know, within basically weeks. Okay, so I think that what we're looking at is a hybrid form. And I really kind of like this form where you guys are in the class, but you're still engaged with Zoom to be able to communicate and interact with your team members and other students. I think that's great. And then you have your stuff right there on your laptops that you can pull up and I can have up on the board here. So I think it's awesome.
yeah.
The only challenge, which I've actually been able to overcome, not in the classroom, but in my working environment, where I've been able to work with students and other colleagues in Zoom in a dynamic virtual environment to basically communicate, to go over material, to set agendas, to be able to do research, to work collaboratively with them, and actually be able to produce research and research reports and projects. That's actually worked really well. For my undergraduate students and less so my graduate students, they just check out, you know, when I teach. Very rarely do I see them on the screen, so I don't really get to know them. I don't get to see them, so I don't get to see their faces. There's really no personal relationship other than I force them to meet with me. Okay. Because it's like, how do you build a relationship with anybody when they can't see you? Right? When you don't talk to them. I can build relationships via Zoom. I can do better relationships in person, and I think that's what students really want, is that you know, that personal interaction, that touch, that, you know, what we're doing right here, they want it, they need it, but I think there's a hybrid form. And I'll warn you guys, I talked to a lot of people, and I had a meeting with the Financial Women of San Francisco, and one of their biggest challenges from a lot of their members is they work in these virtual teams via Zoom, and some of the team members don't have their cameras on, and they take it personal, and it doesn't work. So by showing your face, being dressed, being professional, showing up, interacting, working within the technology, it actually works really well. But there's some psychology things that we need to overcome. Okay? But yeah, it just accelerated the whole process. Okay? But I love it because I did my master's in information systems like 20 years ago and studied virtual team dynamics and how to work in virtual teams using telecommunications. And this just basically threw it to the forefront where I actually had to apply. Companies were already doing it, but now we all do it. And we have to train ourselves to be productive and interactive within these artificial environments. Okay? All right, so is everybody clear on the expectations? And then, you know, when you want to upload your material and then communicate with me for me to be able to review it. And then have a mid-semester review, and then you can have an end-of-semester review with me, which an exit interview is always good. And then, but if you don't, that's cool. Just make sure that I've reviewed it, that I know that you're on track, that you're doing good work, so I feel confident to let you go ahead and upload your materials for me to be able to review it on my own, knowing that your materials have met the standards for an A in the class. Okay?
This is a quick question. I know you already answered this question. Regarding the weekly homework assignments,
Yes.
does it have to be handwritten?
I said I would like it, but if you can't do it for some reason, or you don't want to do it, I can't make you do anything you don't want to do. You're going to do whatever you want. You can't just copy and paste. You can't plagiarize. You're going to have to summarize, maybe use bullets or something, so that I know that you read, you know, the problem and you learn the material. Okay? So there's trust. I'm not going to treat you like undergrads. You got to want to learn this stuff, right? And if you don't learn it, they're going to expect you to know this stuff when you get out. And I have students of mine that were very thoughtful in the process, and they learned a lot. Okay? And I was very confident that when they left the class, you know, they had all the skills and insights that they needed to be able to have the economic backgrounds. Okay?
Thank you.
So I'll leave that up to you guys. Any other questions on expectations for deliverables? Going, okay, gone. All right. Let's see, so on the course website, I also have notes to the pre-test. I also gave you resources. I don't know how, and then you have the internet. So I give you plenty of tools to be able to move through the pre-test pretty quickly, and then you can use the book. And here's the resources that you can also use. So it goes pretty quickly if you know what the resources are. It doesn't go very quickly if you procrastinate. And then I would say the only other weaknesses that I've seen in these pre-tests is people write really quickly because they want to move through the pre-test really quickly, and their handwriting is basically horrible. And I can't even read it. And I gotta make them go back and redo it because they can't read it. And there's not enough detail. And they're missing a lot of the diagrams and the graphs and definitions, and it just, obviously they didn't spend a lot of time on it. They were just trying to get through it, to throw it at me, to just feel sorry for them and give a grade or something, but you're really missing out, if you're not really spending the time to learn the material and put it into detail, okay?
We haven't discussed the midterm yet, right?
Huh?
Midterm.
Midterm I'm gonna go through, okay? Once I get through with all this stuff, I'll get into the midterm, okay? And then I have all of the PowerPoint presentations. Did you guys find the PowerPoint presentations? Okay, they have the notes in them, so all you gotta do is study them, break up the material amongst your team members, come in, do a 15-minute presentation, walk us through it. Okay, you don't have to edit it, you can edit it down if you want to, you don't need to add to it, it's all basically there for you to study from. I make you guys do that because I find out that a lot of students don't read the chapters and don't study the material, so it kind of forces you to do it. And then that way I can focus on the application. Okay. And then, is everybody clear on the movie review worksheet? Okay. The first part of the movie review worksheet is pretty straightforward. The part where I always have the problems with a few students is I ask at the end, the very last question is, what would be your policy recommendations if you were advising Congress? What would be your policy recommendations? So you had the financial crisis, which was basically an aftermath of deregulation, where basically you had collusion and you had culpability and corruption, not only in politics, but also amongst the mortgage brokers, mortgage bankers, the Wall Street firms, the banks, everybody was basically in it. And then the economy collapsed and it cost you guys trillions of dollars to basically bail out a bunch of these criminals. So what would be your policy recommendations to prevent that from happening again? Increase regulation, okay? You put the regulation on the books, right? But what else do you need other than re-regulation, which they basically did?
Maybe some type of system to monitor this, monitor behavior, and kind of countermeasures to prevent.
Exactly. So you would probably have, oversight institutions that would basically do the examination, right? And if they found that there was violations in the law based on the examinations, then what would you need?
A way to enforce it.
You need, exactly, a way to enforce it through the legal system. And then if you enforced it, and you took these people to court, and you sued them, then they would be, what would happen next?
Collection.
Yeah, if they were sued and found guilty.
So they lose money, they go to jail,
Exactly, then you would have law enforcement, right? To basically incarceration.
Yeah.
Or penalties, exactly. So you need that kind of enforcement.
yeah, deterrence.
That's right. And that still hasn't happened,
Well, yeah.
as you know.
Yeah.
They did re-regulate, but they haven't really done a good job of enforcement. They haven't done a good job of litigation. They haven't done a good job of incarceration. Okay. And a lot of them should have gone to jail. But the reason why they didn't go to jail is because the politicians were also corrupt in the process. And they would have had to go to jail too, and lost their position in governing. So there's corruption all around. And I think the inside job does a good job. And then pick one more movie. The Big Short, or Too Big to Fail, or Inside the Fed, or Wall Street, something else. Do a fun one. Okay? And you guys could even do it together. So, but the inside
Professor,
job.
have you seen The Wolf of Wall Street?
You know what? I started watching it. A lot of my students like it. I just thought it was pure Hollywood.
Yeah, I don't know how factual it is.
No, it's not. It's all fictitious. But it's fun, and it's about it's about finance and Wall Street. So I say, do one serious one and then do one fun one.
Deal.
Okay. Another one that's really good is called Rogue Trader. It's actually shot out of the UK. It's about this trader that basically racks up billions of dollars in losses and hides it, and then basically goes on the road, with his girlfriend, as they're being chased by the cops, and then in the end he gets divorced, he gets cancer and dies. So it's like a total horrible story. But if you want a good depressing movie, that's a good one. And then here's your memos. So why don't we does anybody have any memos?
I got one.
Okay, do you want to pull it up? And
Yeah, I
we
can share my screen.
take a look at it. If anybody else, you know, has it, we'd love to see it. And if you have a, okay, so this is yours?
Do you see it on the Zoom?
Yeah.
I don't see it up there, okay, yeah.
Okay, hold on. Let's see, how do I, you should be able to get it up there. How do I do this?
Maybe open Zoom from your computer?
Huh?
I don't,
No, I'm already in Zoom. And you're here. I don't know, is it this?
yeah, there
Oh,
you
there we go. Okay, got it. I'm still learning the system.
go. Yeah, same.
Okay, awesome. So this looks good. The spacing looks good. This looks good. You have a little bit too much space right here. Stock prices forecast to fall 4% over the next 3 months. We are tracking stock prices. Probably a little more space between the line and this first paragraph.
Okay.
Based on our research, we forecast stock prices to fall 4% over the next 3 months based on the following factors: inflation risk, I like it, fear of spread of Delta
Yeah, it's weird
strain.
something.
Is Delta capitalized? You might
No.
want to just check it.
I'll check, yeah.
I believe it is.
Okay. And tech stock, and I would say, and tech stock sell-off. Okay, that looks good. Therefore, comma, we recommend the following 36 trades, colon, good. You got 3 indices, 3 ETFs, and 5 stocks, excellent. You're gonna write forwards, write futures, write calls on futures, buy puts on futures. That looks really good because it's in upper and lower case. You're gonna sell short, write calls, buy puts for both the ETFs and the stocks. Good, 3 times 4 is 12, 3 times 3 is 9, 5 times 3 is 15 for a total of 36. Here's the 3 stock indexes. Here's the 3 exchange traded funds based off the indexes. And then here's 5 stock tickers that you picked. So that, I would say my only comment, it's not a big deal, but if you could get rid of the spacing
Wait,
before and after, you see the spacing here?
you mean like in between the lines?
Yeah, right here, see that space above, like the indices and under? You have space before and
Oh, okay,
after
I
the
see what you're
text. If you can collapse that, this table will become a lot tighter.
Okay.
Okay, just aesthetics, right? And then you here, what I would do is when you're doing the graphs, see if you can put the graph in with a white background so that it's white and white
Okay.
or black and black so it's consistent. Make sure that the height of the graph
They're the same.
for each of the graphs match each other, and the width of the graphs match each other too, with a little space between them, okay? And then if you don't have labels, titles on your graphs, you need to use the text boxes to put in the titles, okay? So that's the graphs, okay? And then over here, make sure that you're using single line spacing and a space, one space between the bullets, okay? Make sure you have periods, okay? And then what you want to do is you want to have data and analysis in each of your bullets. You know, in 2021, comma, GDP was revised up from 6% to 10%, you know, over the next 12 months period. So you're giving a time period, you're giving a number, you know, or the stock index is projected to rise from to, you know, over some period up some percentage point. That's analysis. So it's time period in which it changed, the metric that you're using, either the index or the prices, and then the percentage change of the prices or the indexes. Now that's analysis, okay? Investors debate whether the Federal Reserve lets inflation get out of hand.
So try to find a figure for that rather than.
Yeah. So, and that's kind of slang,
Okay.
right? So I would say investors are debating, so remember present tense, future tense, active tense, okay? That's business. Okay? Investors debating whether Federal Reserve to let inflation accelerate, comma, from 4% to 8% in 2021. Okay? Comma, due to overly accommodative monetary policy. Okay? So you can put in a qualifier. You can talk about the data and where it's going to go, or the changes, and then put in a qualifier. Okay? COVID-19 cases, I don't like to use have increased because that's past tense. COVID-19 cases,
Has would be better?
I would just say rose.
Rose, yeah.
Don't use has, don't need it, don't need the in most cases.
Got it.
So in business writing, as opposed to journalistic or English, it becomes really, really tight. And the more words that you can get rid of to shorten it up and make it really concise, the better off you'll be.
So I know we want it in the present tense, but would increased 17%?
I wouldn't even, I don't like increased, I don't like decreased, I don't like increase, and I don't like decrease. I like rose, fell, dropped, dropping, rising, rise, up. You know, those are more sharp, to the point, dynamic, active, really kind of in-your-face writing. That business is supposed to not only create attention, but also maintain attention for the reader. Okay, so you got to keep it very dynamic. COVID-19 cases rose 17%, I would just say in July, comma, adding additional risks from economic shutdowns. Not economic shutdown, but economic shutdowns. So I use in plural, right? Active. Okay. Tech stocks sold off at a higher rate in July, comma, as reflected in price drops of Apple, -3%, Microsoft, -2%, and Dell, -4%. Okay,
Cool.
so what I try to do is be concise, and then I use the punctuation to make it dynamic. Okay. And then what I would do is, you might want to put in one more bullet here to fill up that white space.
Okay.
Your bullets
Or get more
should
in
be,
depth.
your bullet should be, 2 sentences. It could be one sentence, could be one sentence with a comma and or, but whatever. You could do 2 sentences with a conjunction. So it's a compound sentence with subject, verb, agreement, simple, semicolon, therefore, moreover, furthermore, comma, and then the second compound sentence. Okay, they kind of tie them together, so you can use the punctuation.
And then, so I got my information from Bloomberg.
You don't
Is
know
it
citations.
Bloomberg? Yeah, I'm saying like Bloomberg's a great source, Yahoo Finance, all those places.
Yeah, and what I usually do is I'll copy and paste the content here, and then I edit it down.
Okay, cool.
Because they're usually too wordy, they're writing to a mass population.
Yeah.
So they're more wordy, but these memos are basically written specifically to senior level executives and traders trained in finance and economics. So it's really get to the point.
Cool.
Okay? All right. So, anybody online, do you have any questions in regards to the memos? Are you guys stuck? Can I get some feedback? Because a lot of times students will procrastinate, then they'll wait till the end of the semester. Then they go, Professor Susan, I need you to look at my memo, and I look at the memo and it's like, this is a disaster. It's like, where were you 2-3 weeks ago? Oh, I didn't think the memos were that important. Like, no, Memos are extremely important. Because all my graduates say, you know, I took for granted the memo writing exercise. That's all I do now, is basically write emails. You know, and you trained us how to do it. So, anybody have any questions on the memos? I know Angelo and I have already worked on it. Joseph, you got any questions?
No, sir, not at the moment.
Okay, so can you get me a memo as soon as possible?
Yes.
Set up an appointment?
Yeah, I'll set one up with you after this,
Okay,
after class this evening, if that works.
Francois, how about you? How are you doing?
Yeah, I haven't tried one yet either, but I'll get on that as soon as
I highly
possible.
recommend too that you work with other people that have already perfected the memos so that they can basically help you. Okay, and I got no problem working with other people, have them perfect their memos, give you their memos for the template purposes, and then you update the materials based on your materials within the template. Okay, because it's in the formatting. Right? Once the formatting is done, then I audit the content and the analysis. Everybody thinks, oh, I spent so much time writing this content that basically you should just take the brilliant content, you know, as basically a reflection of the quality of the memo. No, you're not going to give a crappy memo to a senior level executive. The first thing they're going to do is check for the formatting. And if there's any errors in the formatting or punctuation or spelling or any of that stuff, they're not going to read it. Okay, so they're going to check it to see if it's based on the standard. Then they'll start reading it. Okay, so it's formatting first, then content. Okay, Angelo, I know you're set. You're going to show me oil and I think gold too. Danielle. Oh, you're on mute.
Oh, there we go. What's up, Professor?
How you doing? Do you think you can get me a memo that I can check out?
Yeah, I believe I already put one in my drive.
Okay, cool. Well, just set up an appointment so I can go over it with you.
Okay, perfect. Just email you and set up an appointment?
Or you can pull it up right now.
I would love to.
Yeah, pull it up. Let's do it.
Let's do it. All right, hold on.
And then after we do Danielle, then we'll do we'll see if anybody has a couple pre-tests that we can take a look so you guys can see the product. All right, awesome. Okay, so this all looks great. Did you use the template?
I did use the template.
Okay, there you go. We are tracking United States stock market prices. I would just say we are tracking stock prices.
Okay.
Okay, based on our research column, we forecast stock prices to fall 4% over the next 3 months based on the following factors. Okay, okay, got it. I would say rising COVID-19 infection rates.
Got it.
Falling S&P 500, falling S&P 500, how do I say, downward trend in S&P 500 index.
Okay.
Okay, comma, and you need one more. And I would say, the next one I would say, and inability of President Biden to move through his original infrastructure and budget proposals. Because that's going to have a negative effect on the economy, which is going to have a negative effect on stock prices. And you can get rid of global in your RE right there. You don't need that. And since you're forecasting that stock prices are going to go down, you're going to write forwards, write futures, write calls on futures, buy puts on futures, upper lower case, perfect. Sell short, write calls, buy puts, perfect. Same thing here. 3 times 4 is 12, 3 times 3 is 9, 5 times 3 is 15, perfect.
The tickers are correct. I have to change these. These are from the template.
Yeah, exactly. So you're going to use the S&P 500, comma Dow, comma NASDAQ. Okay, and then you're gonna find 3 indexed ETFs, put the tickers there, and then you got your 5 stock tickers right there. Boom. These are right justified within the cells. This is a nice tight thing, but this right here, therefore we recommend the following 36 trades.
Yeah,
Colon
I need
needs to
to
be
get
above
this
the
moved
table.
up. Oh, if it wants to.
Yeah, it needs to be above the table. So you're gonna have to play with the formatting.
Yeah,
Okay, and then make sure you
I'll
have
figure it out.
2 graphs. Right, you're gonna have 2 graphs.
yeah, there aren't mine, those are
Same
the other
height,
ones.
same width, with a space between them, and a space between the table and the first graph, and a space between the bottom graph and the concluding thesis statement. The introductory thesis statement is the concluding thesis statement. The concluding thesis statement, you change following to above and the colon to a period. Okay,
Perfect.
and that's it. And then let's look at these. From the Global Growth Index, U.S. growth, I don't know what we're talking about. We're talking about economic growth, GDP.
It's economic growth.
Okay, measured by what? Oh, that's the index?
Yes,
Rose in 1Q, so that's 1Q21,
yes,
okay? Rose in 1Q21, you don't need 2, 0.4%. From Q420, negative 1.2%, you don't need the apostrophe S. I would say globally, more than half the reporting countries began 2021 with negative growth. Okay, I'll take it. The Consumer Price Index, all items, you don't need index, you already said it, rose 5% over the last 12 months. Good. Gold prices dropped 5% during what period? So like in July or year to date or since January?
it is, when was it? I believe it was at the end of July.
Okay, so just say in July, comma, and then make the G smaller case. Gold prices dropped 5%, comma, and expected to continue to fall as stock prices rise. Okay. Got it. Okay. Dow Jones Industrial Average. Okay, when? In July?
Yes, these are all from July.
In July, comma, Dow rose 400 points or 14%.
And then I gotta get a little more information on which stocks specifically were affecting this increase.
Yeah, so slow economic growth will have an impact on stock prices. Rising inflation will have an impact on stock prices. Gold prices falling. If gold prices are falling, then people are selling gold and probably buying stocks. Okay, so that one doesn't necessarily support. Okay, they're selling gold and buying stocks, which means stock prices would rise, but you're saying stock prices are going to fall.
Oh,
So it
okay,
doesn't really
so
support-
it doesn't support my main
It doesn't.
argument.
It doesn't support your forecast.
Got it.
Okay, so you can redo this, maybe still keep it, but just play with it a little bit.
Mhm.
You could say, in July or since the beginning of the year, gold prices rose X%. Right? Rose X%. This is expected to cause stock prices to fall over the next 6 months, or fall X% over the next 3 months. Use your forecast percentage in your time period and put it in there.
Okay.
Okay? And then Dow Jones rose, blah, 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 blah. The stocks that most affected were slow economic growth, rising inflation, and gold prices falling. So what I would say, you could say the Dow rose 400 points or 14 points year to date. However, stock prices are forecast to fall X%, for through the end of the year due to slowing economic growth, rising inflation, and falling gold prices. Something like that.
Okay.
So again, kind of changing the logic so it supports your forecast. Okay?
Okay, got it?
Okay, anybody else? Does
Thank you.
everybody understand kind of what we're doing? Okay, cool. Once you get the logic down, once you get the first template down, then oil and gold will be easy. Bonds are a little bit harder because, right, bond prices and interest rates move in different directions. And the question is, why are bond prices moving? Is it because of higher inflation expectations driving up interest rates that's driving them down, or vice versa? Or is there just more demand, for bonds driving up bond prices, driving down interest rates? Or are people dumping bonds, driving down bond prices and driving up interest rates? So is the movement in interest rates and bond prices coming from the inflation expectations and interest rate side? Or is it coming from supplier demand for bonds on the price side, driving the interest rates up and down? And when you read and form your own opinion, you'll know what side it's coming from. Okay, all right. And then the last one, which is harder, is currency. Okay, the U.S. dollar or USD. Okay. Now you're not doing prices; you're doing values. Okay, that's the first thing that changes. Okay, and then again, there may be bullets, and there may be graphs, and there may be factors, if they're economically correct, that you can use in the other memos. Okay, but there's going to be something unique. There's going to be some factors or factor that's going to be unique to that asset class. Okay, all right. Any other questions? Yes, no, yes? No? Anybody got any questions? Okay, so that's kind of the memos. All right, and then we already went over the memos. Okay, that's awesome. Okay, I wanted to go through some economic indicators, some sources of economic data. Okay. And I did post up on the website my most recent economic presentation that I've been giving to industry organizations. So I get all of my information from these data sources. So I think it took me about 12 hours to update the deck that I provided you guys. And I sent you did I send you the video link?
Yes.
Yeah, okay, good. So you can see how I present too. So I was able to update my deck in basically 12 hours, where before it used to take me about 2 weeks to do it. Now with the ability to take pictures and copy, paste, GIF, and PIC files into into your PowerPoint presentation, you can construct these things pretty quickly. They still take a lot of time, but nothing like it was in the 90s and the first 10 years of the 2000s period. So here you can see right here, they give you the consumer price index. And the first thing that I do is, this is the monthly change. I basically first thing I do is, that's a monthly change. I can multiply that by 12, right? But usually I multiply it by 10, just to get a run rate. So if I multiplied 0.9%, which was June's inflation number, what's the annual rate of inflation? 9%. Is that high?
Yes.
Yeah, that's the highest it's been since the 70s. We're in hyperinflation. Okay? The Fed's going to have to do something about it. If they don't, the bond market's going to freak out. The Fed is willing, like we talked, to allow for inflation to continue to run hot, because they're more concerned now about COVID, but a double-dip recession. People are saying the Fed's making a mistake. Okay? I would probably agree.
At what point, at what percentage is panic time for hyperinflation?
This is.
9?
Yeah. You know, usually it's about 20%, that's what we had in the 70s. It was totally destructive. This is destructive. And any economist you talk to, myself, or anybody else that actually tells the truth, they're saying this is a disaster, okay? And the Federal Reserve should have stepped in earlier to basically quell the inflation and at least mitigate it. But since they did it, by the end of the year and into next year, the Fed, if the inflation continues to run this hot, they're gonna jump in and start raising interest rates. Okay? And that's gonna cause the short-term interest rates to rise above long-term, because the long-term rates are starting to come down. Once the curve inverts, we know it happens.
Recession.
Yep, every single time. So what I like to do, when I'm doing this, and I'll show you a little trick here, is you click on this little graph right there. Okay, this is the monthly, so look at that. So you went from basically deflation last year to pretty high inflation. So what I do is I go over here to more formatting options. I click on the 12-month percent change because I like to look at things in annual rates. This actually lets you go back to like 1947. I can retrieve the data. And this was the inflation path. Can you guys see that? So this was basically volatility and inflation coming out of post-World War II. Then we had an inflation spike, it looks like at the end of the 50s. Okay. Then basically we had the Vietnam War, and we had the war on poverty, which created hyperinflation. And then we had basically a peak in the late 70s, again, war on poverty, Vietnam War. Then Volcker came in, raised interest rates, killed inflation and the economy, sent us into 2 recessions, and basically we were in a pretty nice, inflation band with a target inflation rate of around 3%. Okay? And then you can see we spiked again in 08. This is the Great Recession, and then look at this number right here. Look at that inflation. It's straight up. It's not trending up, it's straight up. So then the question becomes, when did it ever spike like that before in history? Well, it was kind of like that in 08. It looks like it spiked up in 85 when we came out of, the early 80s recession. The slope is similar to the inflation spikes of the 70s and the inflation spike of the 1950s. So that's what we're looking at as economists. That's the technical analysis. We like to look at the charts, look at the patterns, and then compare what's happening now to history. Okay. All right. So that was, and this is the Bureau of Labor Statistics, okay, or the BLS is what it's called. Here's the unemployment rate, right here. So you can see the unemployment rate peaked at 15% last year. Okay, the highest, I can go back, do format options and take us back to post-World War II to get an idea of how bad it really was. And you can see here that basically the unemployment rate last year at 15% was the highest it ever got post-World War II. As the economy shut down and laid everybody off. Now that's the unemployment rate. That's the number of people that are actually taking unemployment divided by the labor force. Okay. The problem is the unemployment rate has started to come down as people started to get hired again, but a lot of people have rolled off the unemployment numerator because they ran out of benefits. So the unemployment rate artificially falls as people exhaust their unemployment payments. So it's not a very reflective top line number. Okay, they like to report it in the media, but again, as an economist, I'm always saying, well, the unemployment rate is a headline number, but the thing I really care about is underemployment. Okay, people who have been laid off that are working in jobs not conducive to their skill sets. You got PhDs that were lab assistants at some companies that are now driving cabs. Or maybe they can't even drive cabs now, right? So they ought to be doing something else. So if that's the case, that the underemployment rate was double the unemployment rate, what was the underemployment rate at the peak of COVID? The unemployment rate peaked at 15%. So the underemployment rate was what?
By 30?
30. Is that a lot?
Yeah.
Yeah, when you have 30 out of 100 people that are underemployed, yeah, that's huge. And then still, the unemployment rate is roughly about 7%. If we double it, then the real underemployment rate is what? 14. Okay, and that's still pretty high. Okay, so as unemployment rates rise, inflation expectations fall. As unemployment rate drops, inflation and inflation expectations rise. Because as the unemployment rate dropped, which it did to around 3% at the peak right before COVID, the natural rate of unemployment, the non-inflationary rate of unemployment called NAIRR, basically states that the non-inflationary rate of unemployment is 5%, okay, between 4 and 5%. So if the unemployment rate is at between 4 and 5%, wages are growing at the inflation rate, okay? So if the unemployment rate drops below 5%, then wages are growing above the inflation rate, okay? Got it, and if unemployment is above the structural unemployment rate or the natural rate, then wages are falling or not growing, they're growing below the rate of inflation, okay? Now what's interesting, if you look at wages, wage growth, historically, for non-farm manufacturing workers, the wage growth has been 3%. And if you look at historical inflation going back over the last 30, 40, 50 years, the inflation rate was 3%. So if your wages are growing at 3% nominally, and the inflation rate is growing at 3%, what's your real wage growth?
0.
0. And if inflation is running higher than nominal wage growth, then your real wage growth is doing what?
Decrease.
Falling. Okay? Falling. All right? So this is the way we think about it. Now, do you want wages to grow faster than the inflation rate?
Yes.
Yes. Because what's happening to real household incomes?
They're being reduced with
No, if the inflation rate is less than the job growth, then what's happening to real income? Increasing. What's happening to household income? Increasing. So what would be happening to consumption? Increasing, exactly. So that's what we're looking at when we look at these numbers. That's the theory that we're applying. Okay, so that's unemployment. And then we got payroll employment. We added 850,000 jobs last month. During the boom periods, we were adding 1 million. In May, we did, I think, like 500,000 or 600,000. We need to be generating between 250 and 500,000 jobs per month to absorb all the people that are unemployed, underemployed, people that have left the labor force, and Gen X, Gen Y that's entering the labor force as they leave high school and as they leave college, to absorb all those workers. Okay, and then hourly wages, let's look at that. This is an interesting graph. I like to go into options. I like to use the 12-month year over year. I like to go back in time to get some perspective on what's happening now. So you can see that job growth right here. You can see right in there. there, so 2%, right, in here. And then it looked like job growth was starting to increase, and then look, it spiked right before the pandemic. So we were actually seeing very healthy wage growth for the first time in decades, okay? Then basically the pandemic hit, post-pandemic adjustments, and a collapse basically in wage growth. And has wage growth started to recover? Yeah, so that's a positive sign for the economy and for consumption. Okay. All right, excellent. I'm just getting kind of right into the application. The book goes through a lot of this stuff, but the book's out of date. The book talks about the theory, but we're applying the theory. Okay. Employment cost index. Producer price index, is that going up? Is the producer price index going up?
Yes.
Is it going up faster than consumer prices?
Yeah.
Yep. If producer prices go up faster than consumer prices, do you think the producers are going to pass on that inflation to the consumers? Yep. And then the employment cost index. What's happening to the cost of employment?
It's getting more expensive.
Yeah. And is that inflationary?
Yes.
Yep. Productivity gains. Productivity is increasing. If people are more productive, what does that do to corporate profits?
It enhances, increases.
Increases corporate profits. So what would that do to the stock market?
It increases it.
Got it. And then if people are more productive, what would that do to inflation?
It reduces it.
Yeah, exactly. So we're seeing inflation, but we're seeing higher productivity, but that could be transitory. We need to continue to monitor it. And then what's happening to import prices and export prices?
Both increasing.
Both increasing. So if we're importing goods at higher prices, what happens to inflation in the United States? Goes up. And what about our export prices? Are they going up?
Yes.
And what does that tell you about economic demand for our goods in the global market?
It's increasing.
Also going up. And if the export prices are going up, what does that tell you about global inflation?
It's going up.
Going up. Okay. So these are the things that we're dealing with. Okay. And these are the, this is a great website. And then what I like to do is go right here into the West, right here. Go to California. What I can do very quickly is pull up a dashboard of economic factors for California. So right off the bat, I can look at the trend in employment. Looks like it's going up. Unemployment looks like it's going down. Those are all good. Here's non-farm employment. Looks like it actually is turning positive for the first time. I can do it by construction. I can do it by technology. I can do it by professional services, education, leisure, government. Looks like government's continuing to.
Can you go to the technology real quick? Is it going up or down?
Right here, information technology is going up. And what I can do too, what I like to do, like when I'm speaking to the groups down in Silicon Valley, I'll click on that chart. I'll go up here, more formatting options. I'll go all the way back as far as I can, and I can use 12-month net change or 12-month percentage change, retrieve the data, and focus in on the tech sector. So this is tech. Right? This is information technology for California. Okay. But you can see that right there. Right? This was the dot-com boom. This is the dot-com bust. And then this here is basically a retransformation in technologies due to venture capital applications, right? It's all the app developers, right? Cloud computing, data centers, infrastructure. So another second wave of technological innovation and technological employment. Okay, and who benefits the most from technology?
Corporations?
No, what geography has the highest concentration of
Silicon
technology?
Valley?
Silicon Valley and Cupertino, Sunnyvale, Mountain View, the Peninsula, San Francisco, less so the East Bay, 880, 680, but you know, those are all the areas. So what I can do is that was just California. But what I can do is I can go back up here, go over here to San Francisco or San Jose. I can pick any one of those two. I actually like to use the San Francisco Consolidated Metropolitan Area. So it combines Oakland, Hayward, Berkeley, so Alameda, Contra Costa County, along with Marin, San Francisco, and San Mateo. So basically that's the core Bay Area right there. I like to go into there, look at the dashboard, and then this is what I like to focus on, is more options. I like to go back in time, more options, do the 12-month change and the percent change. And this is pretty striking. So basically, during COVID, we lost about 400,000 jobs. We've only brought back maybe 3/5 of it. How long do you think it'll take for us to get back to where we were before? This was a year.
At least 2-3 years.
1 year, 2 years, 3 years. Just to get the base back to where it was. Okay? That's pretty sobering. The other is this. So we were kind of cranking along, pumping out jobs. COVID. That's unprecedented. That's Six Sigma. That's outside the 2 standard deviation probability. Never happened before in history, period. And then what's the recovery doing?
It's skyrocketing.
Yeah. Yeah. Is that a positive sign?
Yeah.
Yeah, totally. So even though this was extremely destructive, the recovery is very rapidly in the Bay Area because it's tech-centric and it's a more dynamic economy, that the recessions, usually barring the tech recession, they're very short and shallow. So we get into it and we get out of it quicker than other metropolitan areas. LA is just massive, right? Northern California is not as big as LA. LA is just like a huge ship, okay? Very big economy. We're tech-centric. LA is very diversified. So LA moves slower, and it's not going to be as sharp of a dip or recovery. It's going to move slower, and it's going to come out of it slower because it's so big. So different geographic areas have different economic base compositions that causes them to fall into recessions and come out of recessions at different rates in different magnitudes. So I'm giving you a little urban economics.
What's the name of this website again?
This is called the Bureau of Labor Statistics, or the BLS. Okay, so that's a pretty good website. Then the next one is the Bureau of Economic Analysis. This one's not as user-friendly as the other one. I still have a hard time being able to get graphics that I want from this website, but I'm able to get graphics that are good enough. So for example, here's gross domestic product, which is a coincident economic indicator that's used to track the business cycle. Okay? We can use gross domestic product, comes out on a quarterly basis and is revised every quarter. Industrial production tracks the economy in a coincident way, but it's published every month. So I like to use that. So if you click on gross domestic product, here is the GDP growth rates. Everybody online, can you guys see all this stuff? Okay. So you can see,
share your screen on Zoom too?
excuse me?
Do you mind sharing your screen on Zoom as well, just so it's a little bit more clear?
Okay, I thought I was doing that. Oh wait, let me see if I can do it, hold on. Oh yeah, got it. Okay, how's that?
Yeah, great, thanks.
Okay, got it. Okay, so here you can see what happens is when you have these kind of extreme events, it widens the range and compresses all of the data. Okay? This is unprecedented. Never seen it before, gotta go back to the 20s and 30s to find it. Never happened before. As you can see, GDP basically has ranged between 2 and 5%. The Fed's target is 4%, okay? So you can see we kind of peaked out in GDP in the first quarter of 17 and 18, okay? We never really got back to that level after that period. So really the business cycle peaked between the fourth and the first quarter of 2017 and 18. That was the peak. And then it was starting to decelerate, okay? But it was still positive growth. Then COVID hit, then the depression hit, then the recovery bounced back. This is annualized, so it's the quarterly change in GDP times 4, okay? So it magnifies it. So this annualized quarterly change in gross domestic product was negative 30%, okay? Even though real GDP didn't contract that much, it contracted around 10, but the way that this is calculated, it exacerbates the calculation. And then it bounced back about 30%. Okay? So this volatility kind of screws up everything. And then you can see that the economy has started to normalize right here. Reported at roughly 6%, 6 to 7% in the first quarter, and they're forecasting 7% for the second quarter, the third quarter, and the fourth quarter to be between. They were forecasting 10%, but now they've revised the projections down, now because of COVID, now because the Biden plans aren't as stimulative. Some people are actually forecasting that short-term interest rates will rise because of inflation, and that'll cool the economy over the next 6 to 12 months. So people are now starting to forecast what it's going to be like for the second half of the year. That's what everybody's asking me, but everybody wants to know what's going to happen next year. How long is this going to last, Larry? How long is the recovery going to last? When is the next recession? What should we be concerned about? And I tell them, I say, well, if inflation continues to go up and the Fed steps in and raises interest rates dramatically at the end of this year or beginning of next year, the stock market will probably peak in 2023 and we could be back in a recession in 2024. So we got 2 years. Hopefully it won't happen, but that's what we're planning for, okay? That's what we use in business. People want to know because they need to plan, okay? Not only strategically, but also tactically. To put in risk management policies, maybe be a little bit more conservative, to be able to handle if there is a double dip, that they were prepared for it. They'd rather be prepared and not have it happen than to not be prepared and have it happen, okay? So this is where the economics come in for business planning. You can also have personal income, international trade, international transactions. The next one is the U.S. Census. Okay, here's wholesale inventories, manufactured goods. They do population, they do construction spending, household incomes, migration. The U.S. Census is done off the decennial census and the census every 10 years. So they have the big census that's done every 10 years. Then they do a decennial, which is basically a small census every 5 years. Businesses use census data all the time because it gives us race, age, gender, company concentrations, occupations, population, migration, households, all of those factors that we use for modeling purposes for corporate, for business purposes. Not only planning, but also marketing research. Okay, so the census is an awesome source. And then there's lots of like Equifax, Claritas, other secondary firms that package and repackage the data into psychographic, demographic data sets that then can be used by businesses when they're doing trade area research or market research or whatever. We just did an analysis a couple weeks ago for a data center company that actually we got a preliminary commitment from them today to engage us on a consulting basis and potentially hire us as a virtual strategic research vertical for the company as it expands throughout the South by deploying data centers into the South. We basically took census data, calculated population to data center ratios, and multiplied it across all of the metro areas in the United States that were within specific ranges that we calculated the ratios. So we stratified the metros by population ranges, calculated ratios, and we're able to calculate the demand for data centers for each metropolitan area in the United States. Those dudes were blown away. It was a very simplistic model. Then they said, hey, I'll tell you what you do. We'd love you to do. We were so impressed with your students and their research and what you guys have done. We'd like you to look at our economic model and critique it and give us some recommendations on how we can improve the model and maybe other data sets and other data that we should include. So they basically gave us, me and my 5 students, are basically going to audit the model, write up an assessment and an audit of the model, and then we're going to give it to them. And if they like it, we're going to ask for $10,000 and a contract with a retainer and potential to engage us as a virtual research vertical within their within their data center firm. And that company's going to go from $300 million to $3 billion in assets under management within the next 5 to 7 years. That's how you use the economics. That's how you use the data. Okay? So it's not just data. It's model building. Here's the Organization for Economic Cooperation and Development. You can go into the data. You can pick up data sets. There's all kinds of stuff. There's all the data for each of the individual countries if you want to create macro factor models on a global basis. Okay. We're doing a comparative housing policy paper right now that we're going to publish. And we're going to go in and get the data from the OECD, marry it with the housing data, and then come up with some economic insights. You know, and put that in the paper and publish the paper, either as a journal article, or we're going to publish it as a book. I want to publish it as a book. Okay. Stockcharts.com, we went through that last week. Big charts, we went through that. The Bloomberg is a great site to get data. The Wall Street Journal, okay, is another great site to be able to get data that you need for your market updates and your memos. The Financial Times is also another great source of data. The Economist, I gave you access to a lot of these. The Economist, another great site to get data. You have access to that. Here is the New York Stock Exchange website. A lot of resources there. The National Association of Security Dealer quotes. Again, a lot of really good data on there. Here is the site for the Chicago Mercantile Exchange, which basically is the largest derivatives exchange in the world. So a lot of these people track these indexes, forecast these indexes, and then based off those indexes, futures and forward contracts, futures contracts, option contracts on the futures contracts are traded off of the Chicago Mercantile Exchange. So if I'm a farmer, you know, that raises pigs, and I think that pork belly prices, or pig prices are going to fall, which means my revenues and my profits are going to fall, I can basically, over the next 3 to 6 months, I can go to the Chicago Mercantile Exchange, look up the futures and option contracts on pork bellies. I can call a commodities dealer, broker-dealer, trader, and say, I want you to write forward contracts, write calls on futures and buy puts on futures to hedge off the market risk of declining pork belly prices over the next 3 to 6 months and hedge. Okay, so I can do that too. Maybe I'm a restaurant that buys bacon, you know, Bacon's Restaurant. You know, I got a franchise. That's all we do is it's bacon, right? Is everything that we do. Well, if I think that, you know, pork belly prices and bacon prices are going to go up over the next 3 to 6 months, well, heck, those input costs into my business is going to shrink my profit margins, which could have a negative impact on my stock price. So maybe what I do is I go call the commodities broker, I figure out what the impact could be due to rising pork belly prices over the next 3 to 6 months, and I tell the broker to buy forward futures contracts and buy calls on futures or write puts on futures, so that when the pork belly prices go up, I'm making money from my derivative contracts to basically offset the deterioration in my profit margins. So I could hedge off that way too. So the economics behind the indexes that are used to calculate the pricing movements of everything, the Chicago Mercantile Exchange designs the standardized futures contracts and option contracts to be able to give speculators, but also other market participants, the ability to hedge off their risk through these derivative contracts, but also to allow speculators who have views and forecasts of where they think these markets are going to go to be able to trade these contracts to profit. And at the end of the day, it's indexes, it's economic models to predict where these indexes and these values and these prices are going to go in the future, and then using the derivative contracts to either hedge or to profit from your economic forecast. And if you're right, that's it. You're in. And that's what the controllers do. That's what people in corporations do. There's whole units. There's economic units that do the forecasting. There's people on the finance side that do all the financial assessments to figure out what the exposures are to the assets and the liabilities. And then they find the tools, you know, the tools, the contracts, the derivatives that they can use to hedge off the risk or take advantage of their insights on where they think the markets are going to go. All right. The other website that's really good is the Federal Reserve Board of Governors. You can go in and get data on interest rates, the Fed's balance sheet, household finance, deposits, currency, you know, how much currency there is in the economy. Currency is measured by what is called M1. M2 is basically currency plus like money market mutual funds and short-term deposits, near cash. A lot of really good information that the Federal Reserve monitors to conduct monetary policy. Here's an example. This is the Fed's balance sheet. As an example, it used to be around $1 trillion that the Fed had on the balance sheet to be able to buy and sell bonds to regulate bond prices, interest rates, and stimulate or cool the economy. Then it went from 1 to basically 2 to 4 to 7. It's now at 8. It's continuing to grow. Okay. The question is, can it go to 16? Can it go to 36? We don't know. There's no theory. There's no macroeconomic theory. There's no monetary policy theory. We don't know what to do. The only thing that we think what could happen is as the balance sheet increases because of massive money supply growth rates, which you can see here. This is basically the monetary stock in M2, which has just gone up over the last 10 years. Here is the relationship between inflation and money supply. So is there a correlation? Does it look like there's positive correlation between inflation and the growth rate in the money supply? Does that look like it's correlated?
Yeah.
Does it look like it's correlated?
Yeah.
Does it look like it's correlated?
Yeah.
So if you're getting rapid increases in the money supply, does it look like there is a correlation in inflation? So as the money supply continues to grow, it's slowed significantly, as you can see, its growth rate, but it's still very high. I'm going to go back in time and look at the level. Okay. And so even the growth rate now is as high as it was in the 70s. Right? Even right here, that was the peak in the money supply growth rates that caused the hyperinflation of the 70s. So even though the money supply growth rate is decelerated, it's still at a level as high as it was in the 70s when we had hyperinflation and in right after post-World War II. Okay? That's what we watch. That's our concern. Okay? And then here is a graph of the money supply growth rates. And you can see unprecedented levels. Okay. Here is the velocity of money. Okay? This is the number of times currencies circulate in the economy on an annual basis. Okay? Now tell me what the trend in velocity was in from the 90s to the, let's say the late 90s. So over that 10-year period, what was happening to the velocity of money? It was increasing, okay? So currency was circulating at a higher velocity in the economy because of demand, okay? Tell me about the trend, or not really the trend, but the behavior of velocity before and during recessions. Is velocity increasing or decreasing during recessions?
Decreasing.
Decreasing.
It's decreasing.
Decreasing. And what's the trend in velocity right before a recession when the economy peaks?
It increases.
Got it. Okay. What has been the secular trend in velocity since it peaked in 98? So it's been, the velocity of money has been in a secular decline since it peaked in 1998. Okay? Is it still procyclical? Does it still peak and decline before and after a recession?
No.
Yes.
Yes. See, it peaked, decelerated, peaked, decelerated. So it's still procyclical, but it is in a secular decline. Okay? And then I'll talk to you in a minute why. What happened to the velocity of money during COVID?
No one was going out, no one was spending, it dropped.
Yeah, but not only did it drop, what did it do?
Straight down.
Yeah, it collapsed. Okay? It was already in a secular downward trend. Here you can see right here in 2008, in the last financial crisis and recession, this was the support line for velocity. It broke through and broke out to the downside through its historical support to the downside, to levels of velocity that we've never seen before, okay, post-World War II. Then COVID hit. It looks like velocity recovered, right? It was actually going up right before COVID, and then collapsed due to COVID. Has it started to recover?
No, it's going back down. On the tail end?
It collapsed, but what is the level of velocity?
Record lows.
Record lows. So the system is still broken, okay? Velocity is still broken. The question is if you want the economy to truly recover, you need velocity to recover. So what's the monetary policy or economic policy for a recovering velocity of money?
You get people to spend more?
That's really smart. Yeah, that's the solution.
But
Okay.
people need
I
money.
looked at the velocity of money.
Try to keep
I
interest.
looked at the theory of the velocity of money to try to figure out why it was in a secular downtrend. First was deregulation. Okay, so the economy, when the Fed prints money to stimulate the economy, the money can go anywhere into the world. Okay, because we have open capital markets on a global basis. So the money doesn't stay within the economy and create a multiplier accelerator effect in the velocity. So it's muted. So one was deregulation, reflected in shadow banking and the introduction of hedge funds. Okay, so a whole nother banking institution. The other was the replacement recently of the use of cash and near cash for electronic payments, and movement of currency into virtual digital currencies. But the number one factor that drives velocity from the research that I did is employment. Labor participation, and real wage growth. Now, does the Federal Reserve control the labor markets and labor market policy?
I mean, it doesn't control necessarily the labor market, but I would imagine it has an influence on labor policy.
Yeah, it has an indirect effect,
Yeah.
but they do not conduct labor policy as monetary policy under the Federal Reserve's mandate. Okay? So who creates labor policy? Who formulates it, who passes it, who implements it?
Government.
Federal
Yeah,
government.
Congress, exactly. And if you go back in time, and look at the enactment of labor policy over the decades to basically cure labor market failures, it's non-existent. So basically, because the government has moved more towards monetary policy, supply-side economics, and using Federal Reserve monetary policy and interest rate manipulation to stimulate the economy, not fiscal policy or labor policy to drive demand in the economy. So they're using monetarism under Milton Friedman, supply-side economics, monetarism, as opposed to Keynesianism. Demand-side policy focused on labor markets, employment, labor participation, and real wage growth.
So they're essentially trying to fix it like after the fact of something happened, rather than just doing anything like preventative working policy, right?
Yeah, the key here to understand this, and I'm kind of getting into the applications here, is that there is neoliberalism. Okay, there's Keynesianism and neoliberalism. Keynesianism, reflected by the Democratic Party, liberalism and monetarism, as advocated by the Republican Party. Okay? Keynesianism, we basically moved away from. Labor policy, towards monetary policy, using interest rates, manipulation, deregulation. Two different economic ideologies, okay? So the economic ideology, as you can see, for labor, for velocity, peaked out in the late 1990s. And it was neoliberalism, monetarism, and supply-side economics ever since afterwards, which caused the velocity of money to collapse. Okay? Now, I'm just doing an introduction. I'm going to do this in the exam when I go through the midterm, but there is part of your homework is to go look up the quantity theory of money. Okay? The quantity theory of money. It's called QTM. Okay? And I'll get into a little bit more of this a little bit later. But the quantity, come on. Okay, so this doesn't work. Perfect. Okay?
I think you need to select the top,
Yeah.
please.
Yeah,
Oh yeah. Oh, God. Thank you so much.
Yeah.
Select square.
Thank you so much. Okay, that one.
Maybe.
Can I get rid of this? No.
No, center,
The
center,
eraser is on the
center
other
right.
side.
Yeah, center right eraser.
On
Where
the
is it?
circle,
Of
on
the
top.
circle on the top.
Right up.
Look at the big blue dot on the right hand side of that.
It's
3
a
o'clock, 3 o'clock.
Rectangle.
Yeah, 3 o'clock, 3 o'clock.
Three
Oh,
o'clock
there
on
it
the
is.
big circle.
Okay, you guys are awesome.
That's, I think that's highlighting.
Okay,
Oh, no,
there
wrong.
we go. Thank you so much. Oh, okay, there we go. Thank you. Okay,
I don't think the folks.
so let's do, there we go, quantity theory of money. Okay, and I'll get into this a little bit more with the exam, but I'm racing to try to get you guys as much information as possible. So here,
Yeah.
GDP real times,
I'm fading fast.
times the inflation rate. Okay? Is equal to or related to velocity of money times money supply growth rate.
Good deed,
Okay? All right.
good read.
Now, the person who invented the quantity theory of money was Irving Fisher. He also created the Fisher equation. So here's the deal. So what's been happening to the velocity of money?
Decreasing.
Going down. Got it. Okay. Now, if the Federal Reserve wants to push up inflation and push up real GDP, what do they have to do to the money supply?
Increase it
Increase it.
exponentially.
Yeah, but aren't they gonna have to increase it significantly,
Yes.
Yes.
more than the decline
Yes.
in the velocity of money? And isn't that what they did?
That's what they did, but isn't it like not enough?
Yeah, well, here was the problem. They were growing the money supply at extremely high rates, but the velocity of money had collapsed. So they, for a long time, they had no effect on inflation and GDP. So basically, monetary policy was ineffective, and that happened for decades. But now we're starting to see inflation, and GDP is not being driven by money supply, it's being driven by pent-up demand, because people didn't consume for over 14 months. Okay? So that's being driven by real aggregate demand. This is being driven up due to high aggregate demand, but also destruction in the supply chains that have occurred, both in the labor markets and commodity markets. Velocity is still collapsed, and money supply growth is still increasing. But the thing that I couldn't figure out is the Federal Reserve couldn't hit its target here and couldn't hit its target here for over a decade. And I couldn't figure it out, because they were pumping a lot of money into the system and holding interest rates really low. So I had to take out my textbook, remember the lecture from 30 years ago, look up the equation, and then start doing the research on these economic indicators, and realize that it was here. That's the problem. Okay? And then I realized also that the Federal Reserve can't do anything about that. Because the theory basically states that the only way that you can get velocity up is through employment and labor participation and real wage growth. So this is the Federal Reserve right here affecting these economic factors. This has to be done through Congress, through policy. And then I went back and I looked at labor policy historically, and it's non-existent over the last 30 years, particularly over the last 20. Occasionally, you'll see some labor policy, but it's intermittent and usually during recessions as kind of a demand response.
So is the money supply growth rate, how you're saying that whether it's gonna go to 18 trillion or 36 trillion?
Well, that's the Federal Reserve's balance sheet, okay? That's growing.
Yeah, so is that growing because the velocity of money is going down to keep the GDP?
No. The balance sheet is increasing because the Federal Reserve is increasing the money supply, taking the money, buying bonds, particularly government debt, okay, our fiscal debt, to drive up bond prices and keep interest rates low to stimulate the economy. Okay? So the money supply growth rate currently is still running high, but velocity is collapsed. But now we have inflation and we got high GDP. Okay? Inflation is due to high demand in the economy because we're coming out of a depression, and because the supply chains were disrupted significantly due to trade policy antagonism between the Trump administration and China, with China and with Canada. So inflation due to supply chain disruptions, high demand, and also you factor in high money supply growth rates. So this could go through the roof based on those three factors all coming together at one time.
So is this more of a correlation than an actual equation?
This is an actual equation.
Okay.
This is called the theory of exchange by Irving Fisher. He's the one who came up with it. And this model, for me, basically explains a lot on how to think about what has happened in the past, what's currently happening, and what's going to happen in the future. And my biggest concern is this, that velocity is collapsed, that the money supply growth rate is still excessively high, and that inflation is starting to accelerate. Okay, any questions on that? I'll go through it a little bit more later, but I just wanted to kind of get right into kind of the midterm. And then here's the labor participation rates. I showed you employment, but here's participation rates. So what did the labor participation rates do? As you can see in the 50s and the 60s in here, where women were basically not part of the labor force. And it was really after the revolution, in the 60s, that women were, emancipated and started entering, the workforce. And labor participation rates for the population started to increase, okay, because of women's participation, in the labor force. And as more people work, right, they do what? If you're working, what do you get?
Money.
Income, right? And then what do you do with the income?
Spend it.
You spend it, you save it, you invest it, you buy cars, your house, send your kids to school. So there's economic activity, that's associated with labor participation rates. And it looks like the labor participation rate peaked out in, 98?
2000?
Yeah, it looks like 88, 89, and in 2000, right? And then it's been in basically a downward, right, as the population starts to age, right, and people start to retire, as the population ages, and older people they're getting sicker, they can't work as hard, they don't have the skill sets, training, education. That's one of the big problems of lower labor participation rates, is the lack of government supports, government policy in education, healthcare, and job training, which is pretty non-existent here in the United States. And then what was happening here in labor participation right before the,
It was staying pretty consistent.
yeah, but look at, wasn't it starting to increase as Gen X, Gen Y, Gen Z started to enter the labor force? So labor force participation rates were actually being pulled up by new entrants, a new demographic into the labor force. And then what happened during COVID?
Dropped.
Did it drop or did it just collapse?
Collapsed.
It collapsed. 2 million women left the labor force. 2 million women left, and that's probably an underestimation. Because what are you gonna do? When you get shut down, schools shut down, who's gonna take care of your kids? Right? So women had to take care of the kids. So they left the labor force, 2 million of them. So and then what's happened to labor participation rates?
It's going back up.
It's going back up, but what's it doing now?
It's still at an extraordinarily low and unsteady.
Yeah, it's still extremely low. So the way I looked at it is that if we take the peak in labor participation rate, right, and said that labor participation rates would be, if they stayed the same through policy, that this integral under here, everything underneath the curve right here, is lost GDP, is lost economic output. So basically, if you want to increase GDP on a secular basis, consistently, over time, for the long run, you need labor participation policies to cure for this labor market failure. So you need policy. Does the Federal Reserve formulate labor policy?
No.
No. Who does?
It was the Congress.
Congress. So you need basically political, alignment, agreement between the two parties in control to basically formulate labor policy to cure for the labor market failure. And what's the probability of that in this environment currently?
It hasn't happened in the last 40 years.
Yeah, what's the assessment, what's the state of political policy making in Washington right now? And over the last 10, 15 years?
Like at a standstill or pretty much at a crawl.
Yeah, really hard to get policy pushed through in some kind of consensus in Washington. So what's the probability of labor policy?
Low.
What's the probability that the velocity of money will go up then?
Low.
So basically the only thing that's left is Federal Reserve policy to try to get the economy to grow, because we don't have labor policy. Okay, all right. So that's your crash course. All right. What time is it? 8:30. Did you guys want to take a little break and then we can come back and do some presentations?
Yeah.
Yeah, let's do that.
Sounds good.
Okay, cool. And again, the presentations could be quick. They don't have to be too long, just, teach us some economics and let's try to have fun.
When do you want us to come back, Professor?
Let's do like 10 minutes.
Okay.
So like 8:40. And then we'll go for like an hour after that. Go ahead.
Okay, yeah, when are you going to be free around, what is it? I think it's coming Friday, you know what time, so like set a meeting with you, just confirm some stuff.
Yeah, for Friday, is that the only time you got?
I got Friday, and I got like the morning and a good chunk into the evening of Saturday as well.
Oh, I can do, I can do like 9 if you want to do it on.
On Friday?
Yeah. Is that gonna work?
I'm
Or
actually,
we could do it on Monday.
yeah, I can do it Monday.
Okay, let's do,
I think anywhere in, a little bit in the afternoon, preferably, because I was.
oh, you wanna do that? Well, you just tell me.
Anywhere between 1 to 2 p.m. Monday.
Okay, so I'll put you down for 1. And what was your name again? I'm sorry.
Quran. K-A-R-A-N.
Okay, I got you down.
Yeah, also a question about the whole, I think you said it was about $88, I think it was, something about.
Oh, the SIE?
Yes,
If you go to Securities Training Corporation,
yeah,
you can go online. I think it's like, maybe like $120 with those guys.
I'm kind of interested in kind of pursuing this.
You should. I can coach you, to help you, pass the exam, but they have a really great program.
Yeah,
It takes about a month.
that's not too much time, I don't know, just like stuff like this, it's
You
like.
should do it.
I mean, I feel like from a conceptual basis, I'm still like really learning about it, but from like, or not conceptual, it's like the concept itself, I actually really like it.
Yeah,
It's just like the little details and like this does this reacts with this is tied to
Yeah,
this.
yeah.
That's the type of stuff that I kind of really need to like get more into.
yeah. That's why
Yeah.
I'm training you on that stuff.
Yeah.
But yeah, you should do do you have time to study for it?
I can probably make the time, honestly.
You should do it.
Yeah.
You should do it.
At the very least, I want at least like somewhat of a background in this, just because like.
Well, the SIE is gonna get you,
Well,
you'll be able to get it, you could go to Morgan Stanley and go into their investment advisor program, which is amazing. They'll pay you. Pay you to get the 7 to 66. They'll train you, you work in teams. You could build an investment, investment advisory practice, and if it works out, it works out. If it doesn't, then it's still a great experience. A lot of really successful people had started off in wealth management and then moved into other areas.
I'm definitely interested.
Yeah, you should do it.
It also really interested me just how like when in the beginning, like firstly how like interconnected everything was and how you were explaining it, and just like the whole, I don't know, like every detail is tied to every other detail.
That's right. And what I'll do is I'll show you in the, maybe I'll do a little bit of it when we get back. I'll show you some of my theory on the interconnectedness between the different disciplines.
Okay.
And that should help.
I'm gonna take my break.
Okay, cool.
Can we just do the PowerPoint at our desk?
Yeah, sure. If that's easy for you. You're gonna have to speak up though, so that these guys can hear.
Or I can turn on my mic if that helps.
Yeah, why don't you do that? Okay.
So just thinking about that equation up there, just because I was a math major, so I'm just thinking about it like,
Oh, yeah.
I'm trying to analyze it,
Yeah.
like what
Yeah.
exactly these things mean.
Yeah.
So if we were to cut the money supply growth rate right now, would that just deplete the GDP?
Yeah.
But the inflation would still, or the inflation would go down because the money supply.
Well, again, what I do is I control the factors. So let's say, holding this constant, and that constant,
Yeah.
if this goes down, this is gonna go down,
Okay.
okay? If
So
you hold
essentially
this,
the
if you
only
hold
thing-
this constant, and this constant, if this goes down, this would go down.
Yeah. So the only thing that is keeping our GDP up right now is the money supply growth rate.
Yeah, because the Fed is buying
Okay.
about 180 billion a month of bonds,
Yeah.
80 billion in U.S. government treasuries.
And are those 10 years or 30-year bonds?
Probably along the whole curve, mostly short term.
Short term?
Yeah, mostly short term. And I'll show you guys a little something later. But yeah, they're holding basically short term interest rates to zero. Okay. In Europe and Japan, they've set them negative.
So in order to keep people happy with the inflation rates and the GDP, they've sacrificed the growth rate by pumping it.
That's what they'll probably have to do at some point.
Okay.
Right now, they're growing this to maintain this
Because
and putting up with this.
yeah, I know from mathematics if a number reaches zero, it makes everything a whole lot more difficult to work with. So if velocity's constant near zero,
Yeah, it's collapsed.
it's collapsed,
So
then everything
The whole thing
else-
was, this was falling, while
Yeah.
this happened for a long time, this was falling, while this was rising, and they had no effect on these two.
Yeah, but now that velocity of money is at near
Now this is
zero,
collapsed,
yeah,
they're growing this at a hyper rate
in order to keep the other two.
to get this up, and they're tolerating this.
Yeah,
And at some point in time,
something's
this is gonna get out of control.
Yeah, something's gonna.
And they're gonna have to start bringing this down, and that, to get this to come down,
And then the GDP will go down.
that'll go down too.
Yeah,
Exactly.
so they're just pretty much pushing that off as long as possible.
They're pushing this off as long as possible.
And is that the reason like the national debt is growing, cause they keep pumping like more money?
That's
into
what
it?
this is.
They keep pumping
Yeah,
more
so
money
they
into
print
it
the
to keep
money.
it steady.
The fiscal deficits are, I think we racked up like 3 trillion. It's usually around 800 billion. So we racked up 3 trillion in less than a year. Last year, the Fed printed about 3 trillion. So that's like 6 trillion of stimulus that went into the economy. That's why those,
Yeah.
that's why it went, like there was so much support
Yeah.
that it basically collapsed and recovered very quickly. Because unprecedented, we've never seen this much fiscal stimulus or monetary stimulus because it was a depression,
Yeah,
you know? So,
but
So-
something's gotta give eventually.
and that might, unfortunately, it might be the inflation,
Okay,
and that could kill a lot of people.
yeah, unless
Because the
wage
lower middle
rate-
class,
That's the wage rate.
the lower class, right? If you're on the margin of poverty, and you're in the lower, class between the 25th and the 50th percentile, the middle class, and your wages can't keep up with inflation, you're gonna fall into poverty, or you're gonna fall into a lower class. So inflation is insidious. I mean, it's awful. And it's funny because the Federal Reserve tolerates it because the banking system and corporate system relies on a certain level of inflation to maintain profit margins. But it hurts, everybody underneath it, particularly the lower class, that just don't have the means or don't have the incomes,
Okay,
or have the income growth. So what'll happen is inflation will push more and more people into lower class because they won't have the purchasing power to
so
be able to
would-
maintain their standards of living and social welfare.
would increasing the federal minimum wage increase the velocity of money in that sense? Because
It has an effect,
because that would
yeah.
in turn make the inflation rate.
Yeah, the supply siders say it's gonna be inflationary, but I actually think the unemployment rate is still artificially low. I mean, people are getting paid significantly less than they're actually worth,
Yeah,
right? And the minimum wage actually sets a cap, but if you lift the cap, the demand for labor is a lot higher than the minimum wage, and actually wages would go up. Okay, and that burdens the business class, but it benefits the working class.
yeah, which in turn helps the entire economy, so.
Yeah, so you kind of, the
Yes, okay.
economic policies have been slanted towards corporations and businesses for decades and away from the working class. No wage supports, no education supports, no healthcare supports, no housing supports. So the middle class has been kind of screwed for the last 30 years. And most of the benefits have gone to the corporate class or the financial and real asset class of people who actually own. Like the 90th percentile, the top 10%, basically owns almost everything.
Yeah.
All the stocks, all the bonds, all the real estate. Everybody else, like you could add up all of the wealth of everybody underneath the 90th percentile, and it adds up. The top 10% control basically everything. So they control government and policy,
Yeah.
right? Because they have the lobbying power
Yeah.
to do it. And there's been some research recently where they looked at congressional policies that have been enacted over the last 30 years. They looked at thousands of bills, and they came to the conclusion that the majority of the bills that have been passed by Congress do not benefit the average American. they benefit either the upper class or the corporate class. Because they have the money for lobbying, is the way it works. Okay, so what time do we have? Let's see, I wanted to,
42.
yeah, I wanted to do one last thing real quick. Okay, I got all that stuff. I just want to do one quick thing, and then you guys can figure out who's going to go first. And then we'll do the presentations, and then we'll end it after the presentations are done.
Professor, are we only doing group one presentation, or are we doing
No, as many
two
people,
as well?
as many people who can go tonight, and then we go next week and the week after, and we just do as many presentations as possible.
Okay, perfect. Just my concern is that Neha isn't here today, I don't think.
Just do the best you can.
Okay.
Show must go on. Okay, if you go up to Google, and type in dynamic yield curve. Did I show you guys this? Did I show you guys this? Did I show you guys this?
I don't believe so.
Okay,
No.
okay, got it. So here is the yield curve, interest rates, maturity on the bonds. There's an interest rate for each maturity, for each government bond. This is called the yield curve. Is the yield curve upward sloping?
Yes.
Yes, it's upward
Yes.
sloping. It's upward sloping, okay? The theory is that when the yield curve is upward sloping, that future inflation expectations and economic activity are positive, okay? So what does the yield curve tell you about future economic activity?
It's gonna boom.
Yeah, it's gonna continue to be positive. Got it, okay? Here is the stock market, measured by the S&P 500 index. 1998, 99, 2000, peak in the economy, peak in the stock market. Then we had the 2001, 2, 3, 9/11 induced recession, and the dot-com bust. Then we had recovery, the housing boom, housing bust, financial crisis, 2008, 2009. Then we had the recovery, unprecedented. As you can see that the stock market, if you draw a line here, these are the resistance lines based on the peaks. These are the support lines based on the troughs. As you can see, the stock market was basically within a range over time. Then it broke out to the upside in 2012 through very low interest rates, and the Federal Reserve has basically kept interest rates significantly low, creating a stock market bubble, and a bond market bubble, and a real estate bubble. And at some point in time, what happens to bubbles?
They pop.
They pop, okay? So let's go through this really quickly. So if you click on animate, down here, what happens is you can see, leading up to the 2000 peak, dot-com peak, and peak of the Mesocycle, does the yield curve look relatively flat?
It's staying pretty consistent.
Yeah, well, it was down here, now it's up
Okay.
here, right? Now watch interest rates go up as you reach the peak, and then watch the yield curve, it will invert. See it invert? Right there? See the inversion? Then we go into a recession. Okay, so once the curve, and then the Fed comes in, once they pop the bubbles, they come in, they start buying bonds, driving up bond prices and driving down interest rates. On the short end, because this is where the Fed controls the short end of the yield curve, not the medium or the long. And you can see that the Federal Reserve is buying a ton of bonds, driving up bond prices, driving down interest rates, to try to put a bottom under the stock market and the economy from careening into a depression or a total stock market crash. This is response, monetary policy responses, okay? So is that an upward sloping curve?
Yes.
It reflects higher inflation expectations in the future and higher economic growth. So the Fed is basically continuing to pump prime the system, causing the stock market to go up. Now watch, as we start to approach the peak, the yield curve, as you can see, is starting to flatten as the economy starts to overheat, so the Federal Reserve starts raising interest rates. Tell me when the yield curve inverts. Yeah, but that was pretty close, wasn't it?
Yeah.
Look, interest rates are starting to rise. That
Now.
inverted right there. And when did the stock market peak?
2006.
About a year later. And then we were in recession within 24 months. Okay? And so you can really see it. And then what happens is that this was the financial crisis, Lehman Brothers, off a cliff. Then what did the Fed do?
Lower interest rate.
Yeah, by doing what?
Buying bonds.
By buying bonds. Got it. Now watch how low the interest rates go. Basically to zero. To zero. And in Europe and in Japan, they went negative. They went negative across the whole curve to try to stimulate the economy through monetary policy. I call it unorthodox, over-accommodated monetary policy, because we've never had zero interest rate policy before, and we've never had negative interest rates on a global basis. It's a whole new thing, right? The textbook doesn't really even address it, because the theory doesn't work. They really haven't come up with any economic theory to explain the implications, long-term implications and ramifications associated with zero interest rate policy and negative interest rate policy.
Did it work in Japan and Europe?
Not as much, not that well. Because their economies in Japan, they've continued to fall into recessions, even at negative interest rates. Europe has structural problems with its economy and its labor markets, where they can drive interest rates to negative and it still won't really create sustainable economic growth. Their economies need to be restructured, okay, through policy. But you can see here how low the interest rates are. Now watch, the Fed will start to buy these longer dated maturities and start bringing down long-term interest rates. But you can see right now, you can see how long-term interest rates have come down. But now we've broken through the resistance line to the upside, and now the Fed has just continued to peg interest rates. It looks like the Fed actually is starting to raise interest rates right there. Tell me when the yield curve inverts. Are short-term interest rates rising?
Yeah.
And the Fed's doing what? Are they buying or selling bonds? Selling bonds. Bond prices are going down, interest rates are going up. Is the yield curve flattening?
Yes.
Yeah.
Isn't that a precursor?
Yeah.
Tell me when the yield curve inverts. It's pretty close. Looks like it
Yeah.
inverted right there. So that was what? The beginning of 2019? And when does the stock market peak?
The start of
Within
2020.
12 months? And then when are we in a recession?
Less than 24 months later.
24 months. So let's say the beginning of 2019, in 24 months, where are we? 2000, 2020? What happened in 2020?
COVID.
And were we in a recession?
Depression.
Depression. So the theory actually was already predicting a recession. We were already going to go into a recession based on the model. But we went into a depression because of what? COVID. Got it. So it was already there. All right, so that's that. Okay, and that's on the midterm. I'll go through it a little bit more afterwards, but that was kind of a crash. That was kind of a crash. Within 2 sessions, we kind of crash coursed a lot of stuff, okay? So hopefully that was helpful. I don't know about you, I think it's extremely interesting, because it's totally relevant. Okay, so do you guys, I think you guys are in control of the screen. And I'm gonna turn it over to you guys. Danielle, are you going first?
I'm group number 5.
You can go first,
we can
doesn't
go
matter.
first. Alright, I think Nadine's in class and Angela's online with me, so let me pull it up. If
Okay.
Nadine, you want to go ahead and jump and start that, I'll pull up the.
Awesome, and thank you guys for sharing the workload and the teaching. I could only do it for so long.
Got you.
Thank you.
I do not like being the big face. I feel like I'm in the David the Wizard of Oz or something. Like trying to get this thing to load quick, so it's like looking at something other. It's coming, it's loading.
Okay,
I got so many, I'm sure you get this frustrated when you have so many tabs open, it just
Totally.
feels like
Oh, yeah.
time.
oh yeah. I gotta optimize my drive all the time.
Gotta optimize, it's the way of life.
Gotta optimize.
Haha, okay, cool. So this, let's do share, boom. Cool, okay, so we, myself, Nadine, and Angela were chapter 5, public goods, public choice, and government failure, and I believe Nadine is starting us off.
Well, I guess I'll just talk very loud. Okay, can everybody hear me?
You're good, Nadine.
Thank you. Alright, so this chapter discusses how government's power to prepare or pressure can be economically beneficial. Difficulties associated with managing and directing the government, and government failure, and why it happens. The last word provides examples of government failure in the news. Next slide. Next slide. So learning objectives. So the first is to describe free riding in public goods, illustrate why private firms cannot normally produce public goods. Learning objective number 2, explain the difficulties of conveying economic preferences through majority voting. And learning objective number 3 is to define government failure and explain its causes. Next slide. Sorry. Yeah. Demand side market failures occur because there are situations when it is impossible to charge all consumers, or any consumers, the price that they're willing to pay. A public fireworks display is an example where people don't have to pay to enjoy the display. Private firms would be unwilling to produce outdoor displays, as it would be impossible to raise enough revenue to cover production costs. A firm can't prevent people from watching the fireworks if they didn't pay. Okay, I think the next slide is on private goods.
Close.
I would probably back up a bit, I think we're off.
Back up. Back up, There you go.
Yeah, there you go, sorry. Alright, so private goods are produced through the market because they have rivalry. come in units small enough to be afforded by individual buyers. Private goods are subject to excludability. This is the idea that those unable and unwilling to pay do not have access to the benefits of the product. Since the goods have rivalry and excludability, private firms can produce and sell the goods for a profit. And a little bit more on public goods. The demand curve of public goods may under-report how much consumers are willing and able to pay. Public or social goods would not be produced through the market because they possess the characteristics of non-rivalry and non-excludability. Non-rivalry means that when one consumes the good, this does not preclude another from consuming the good. Non-excludability means that no one can be prevented from enjoying the benefits of a public good. With non-rivalry and non-excludability, public goods suffer from the free rider problem. What is the free rider problem? This means that many people can benefit from the goods without paying, making it unprofitable for firms to produce these goods since they have no way to ensure that only paying consumers will enjoy the good. As a result, government often provides these goods. An example of public goods includes national defense, public music concerts, and outdoor fireworks display. Now, advance the next slide. So the demand for a public good is somewhat unusual. Suppose Garcia and Johnson are the only two people in society, and their marginal willingness to pay for a public good, national defense, for example, is as shown in the columns of the table. Notice that the schedules in this table are price quantity schedules reflecting demand. To find the demand for a public good, we add the prices each individual is willing to pay to find the collective willingness to pay for each quantity. Shown here is the individual's willingness to pay, which is curves D1 and D2 for Garcia and Johnson. The collective demand curve for a public good is found by summing vertically the individual willingness to pay curves, D1 and D2 for Garcia and Johnson. The supply curve of the public good is upward sloping, reflecting rising marginal costs. The optimal amount of the public good is 3 units, determined by the intersection of DC and S. At that output, the marginal benefit, reflected in the collective demand curve DC, equals marginal cost, and that's reflected in the supply curve S. To the point at which, I think my slides are all mixed up. Cost-benefit analysis. Government can use a cost-benefit analysis, which is a practical way to decide whether to produce a good and how much to produce. Government might use this method in determining whether or not to build a new highway. Next slide. Cost-benefit analysis for National Highway Construction Project. This table shows that the total annual benefit, column 4, exceeds the total annual cost, column 2, for plans A, B, and C, indicating that some highway construction is economically justifiable. We see this directly in column 6, where total costs, column 2, are subtracted from total annual benefits, column 4. Net benefits are positive for plans A, B, and C. Plan D is not economically justifiable because net benefits are negative. But the question of optimal size or scope for the project remains. By comparing the marginal cost, that's the change in total cost, and the marginal benefit, which is the change in total benefit, we can determine the answer. The guideline is well known to you from previous discussions. Increase in activity, project or output as long as the marginal cost, benefit, column 5, exceeds the marginal cost, column 3. Stop the activity at or as close as possible to the point at which the marginal benefit equals the marginal cost. Do not undertake a project for which marginal cost exceeds marginal benefit. In this case, Plan C, building new 4-lane highways is the best plan. Plans A and B are too modest. The marginal benefits exceed the marginal cost, and there's a better option. Plan D's marginal cost, 380 billion, exceeds the marginal benefit, which is 110 billion, and therefore cannot be justified. It over-allocates resources to the project. Angelo, I think you're up.
Yeah, next slide, please.
Got you.
Oh no. Quasi-public goods. Quasi-public goods could be provided through the market system because of positive externalities the government provides them. Examples are education, streets, museums. Quasi-public goods are those that have large positive externalities or spillover benefits, where benefits accrue to some third party, external to the market transaction, so government will sponsor their provision. Otherwise, if they were produced in the private market, they would be underproduced. Next slide. The reallocation process. Government taxes individuals and businesses, takes the money and spends on production of public goods. The government taxes individuals and businesses, which reduces their incomes and reduces demand for private goods, but increases the production of public goods when government spends that tax revenue. Next slide. Public choice theory. Public choice theory is the economic analysis of government decision-making, politics, and elections. Market failure, government failure. Studying market failure helps us understand how regulating markets may help improve the allocation of resources, and studying government failure can help us understand how changes in the way government functions might help it to operate more efficiently. Incentives may lead political representatives to pursue policies that go against the preferences of the people. In the majority voting system we can use make it difficult to know voter preferences. Next slide. Revealing preferences through majority voting. Inefficient voting outcomes. Inefficient no vote under production of a specific public good means under allocation of resources. Inefficient yes vote over production of a specific public good results in over allocation of resources. Interest groups and log rolling. The democratic process is imperfect. Public choice theory demonstrates that majority voting can produce inefficiencies and inconsistencies. In the marketplace, consumers can find and purchase a good that they have a strong preference for, even if it is unpopular with the majority of consumers. And consumers can choose not to buy a good that they do not have a preference for, even if it is a very popular product. But that is not the case with public goods. Because majority voting fails to incorporate the strength of the preferences of the individual voter, it may produce economically inefficient outcomes. People who share a common preference for a public good may form an interest group and use advertisements, mailings, etc. to convince others of their view. Log rolling is the trading of votes to secure a desired outcome and can either increase or decrease economic efficiency. Next slide. Inefficient voting outcomes. Majority voting can produce inefficient decisions. In the left graph, we find majority voting leads to the rejection of a public good that would entail a greater total benefit than total cost. On the right, majority voting results in acceptance of a public good that has a higher total cost than total benefit. Next slide. Paradox of voting. The paradox of voting is a situation in which society may not be able to rank its preferences consistently through paired choice majority voting. Outcomes may depend on order in which votes were taken. Different sequences of majority votes can lead to different outcomes, many of which may fail to reflect the voters' underlying preferences. As a result, government may find it difficult to provide the correct public goods when relying on majority voting. Not to imply that there is a better procedure, it is better than having a dictator. Paradox of voting example. This table illustrates 3 voters in the community who have 3 public goods to vote for. The top part of the table lists the preferences for the 3 voters, and the lower part shows the outcomes of the elections decided through majority vote. The outcomes of the elections appear rational by the time the 3rd election is held, but this is really just due to the order in which votes are taken.
All right, my turn. So, the median voter model, also known as the middle person, suggests that the median voter is likely to determine the outcome of the election. So they talk about many people may be dissatisfied whether they believe very strongly one way or the other. That middle person tends to be the decider. And this phrase, people may vote with their feet, I actually looked it up, and it's voting through actions or showing preferences through action. So the best example I thought of was people who choose not to eat at Chick-fil-A because Chick-fil-A donates to anti-LGBTQIA+ organizations, so people who choose not to eat there, that's voting with their feet. They're voting through their actions, showing a preference. So if any bill were to come up concerning that, if anyone was like, well, I'm not gonna eat there because of these reasons, that's them not only saying they're gonna vote that way, but showing they're gonna vote that way. Right over there. And they could change over time. Obviously, some people have differing opinions as more information comes out or doesn't get revealed. Some people will change their opinion over time. I could just say next slide to myself. Other voting options, quadratic voting. Voters allowed to purchase and cast as many votes as desired, but there's a little bit of a catch to it. I found a really good example. You're really only gonna have people who truly believe in the issue spend the money. So if you have, for example, $100 of voting credits, casting 1 vote for a cause will cost you $1. However, casting 2 votes costs you $4, 3 votes cost you $9, and 10 votes will cost your full $100 of voting credits. So unless someone truly strongly believes in whatever issue they're voting on, they're probably not going to use all of their voting credits. Whereas the quadratic voting doesn't work out as effectively unless someone is very strongly, or multiple people are very strongly believing in a certain cause. A couple things about government failure. Pretty self-explanatory, refers to the inefficient outcomes caused by government. Voting problems, pretty straightforward within mechanical, or we had this issue of people setting up those fake ballot boxes this last election. Principal agent problems, that is task delegated to principals and agencies. So if you set an agency, be like, hey, we're gonna have you be open from 7 a.m. to 5 p.m. and there's some kind of disconnect and they're only open to 3, then that's 2 hours that they should be open but weren't. Special interest effect, it's not efficient, it's trying to target a very specific amount of voters, but it's not gonna help out because the number that you're specifically trying to target isn't enough to move the vote a certain way. Collective action problems ties into special interest. Collective action problems focuses on smaller groups versus larger groups, assuming that smaller groups are willing to gonna rally together to create a larger group. But at the same time, that's a pretty big gamble to take if you're putting all your time, money, and resources into a smaller group to be like, hey, this is why you should vote for this is why you should believe in me, and they're like, cool, we're not enough people to outweigh the other group. Earmark expenditures within broad legislation. So you can have a broad legislation, they have like little things in it, and it becomes so confusing, or the earmarks are not super clarified, and people are like, I don't even know what I'm voting for. And finally, rent-seeking behavior appeals to government for special benefits at taxpayers' expense. So that kind of goes back into people using their, and it's used on the next slide, and Professor, I love that you use this word, clout, to their advantage. I swear to God, it's going to be on the next slide. Yep, right there, political clout. So limited and bundled choices, they really make it very small. There's only 2 to 3 choices for each candidate for the election. For the, obviously, presidential, you go through the preliminary and then the final. But for other things, they may only let a few people run it once. And then you kind of get into the argument of public agencies are less efficient than private businesses, and that kind of gets into, maybe did a really good job touching on it. Public agencies with like fireworks, they're able to host that no problem. Private agencies are not going to do it, but they're not necessarily losing any money or losing any time by not doing something. And then here it is, here comes everyone. Government employees often gain political clout, and bureaucrats justify their continued employment. We see it all the time, all the dang time.